Ernest Bodziuk, dzień dobry, szanowni państwo.
Good morning, ladies and gentlemen. This time we are meeting in May, not in January. You may all well remember that this was in January that we were meeting last year. So this is for the third time that we are already meeting at Warsaw Passive Investment Conference. Isabella Olszewska is with me on stage, member of the board of the WSE, and she's the one to technically and officially open this conference. I'd like to welcome you all very cordially indeed. This is again Warsaw Passive Investment Conference. I would like to welcome those present here in the very room of the WSE, as well as those who are joining in for today's and tomorrow's event remotely. Ladies and gentlemen, I'm more than delighted to welcome you on behalf of the Warsaw Stock Exchange. This is precisely the company I am the ambassador of. This is the co-host and co-organizer of this event. However, let me please take this opportunity to thank other organizers and partners to this event. I'd like to thank mBank, Brokerage House, and Better Securities, as you've decided to co-host this event. There are also other partners, Association of Individual Investors and CFA Society in Poland. This is already for the second time that we have partnered with foreign agents, well-renowned issuers of EFT, Wisdom Tree, Invesco, and we've been joined recently by BlackRock.
Chciałam również wymienić.
And again, let me stress the importance of the presence of the media, Comparec 24 TV, FX Mark, as well as Parkiet magazine. As said, we are delighted that we can be meeting again despite very turbulent times we're living in, that we've managed to organize this event. It is important from the perspectives of the market players, individual investors, private investors. It is also essential for issuers, for passive instruments. It is also important for the very WSE managers and other market players. The growth in passive investment instruments is something well embedded in the postulate for the growth of the capital market growth, as well as what we are intending at the WSE. This trend of passive investment has been gaining importance on the global markets. It has been also something very popular locally. The EFT market keeps growing. We've got a whole menu of investment opportunities, be it for EFTs. We've got a geographic and thematic sectors. We've got also those that don't include ESG factors. We've got a total of 10,000 EFTs traded globally. And after the second record year of incomes, in quarter one, we had 10 trillion American dollars. EFTs are most popular in terms of passive investments, but we need to mention also other instruments which are also gaining popularity in Europe and elsewhere. These are exchange-traded commodities, that is EDC, as well as ETMs. They allow for exposures to commodities, currencies, as well as titles for CO2 emission allowances. These instruments are traded on many stock exchanges, and they are parts of the same basket as where EFTs are located. They are very similar in their purpose, that is, they reflect, they mimic the behaviors of the base instrument, and they follow the pricing of this instrument. ETC and ETNs area is where we are very active as WSE in terms of analysis that we are conducting. But now let's look at it locally. Let me stress that our offer has been broadened. Since 2021, we've seen the emergence of new EFTs on equity indices as VIG 80 and VIG Tech. For foreign indices, the same holds true. Is S&P 500 and Nasdaq 100 come to it. And currently, our offer has been boosted by other instruments for bonds TBSP index. Currently, we've got the total of 11 EFTs traded, 9 of them on the Polish law, issued by our Beta Securities partner. There is more to come for these very instruments of passive investment. And there will be a lot of talking about the modalities of investment. There will be also much discussion around trends, market trends that we are going to stress. And this is going to be addressed by our speakers. We're going to hear from a number of speakers throughout 2 days of this conference. And personally, I'm more than curious to discover what news it is worthwhile knowing in this market segment. What kind of conclusions we will draw all together. To those joining us, either offline or online, I'd like to wish a very fruitful event, a very interesting event. It is my firm belief this is going to be something of a permanent event in your yearly agendas, so that we can meet and talk passive investment. Thank you. This was Izabela Olszewska speaking, member of the board of the WSE. Madam, thank you for this address. And now let's hear our keynote by Anastasios Psoronfagis of Bloomberg.
Hello, everybody, and welcome. My name is Athanasios Psoronfagis. I am an ETF analyst with Bloomberg Intelligence, and I'm honored to be able to do today's keynote speech for the Warsaw Passive Investing Conference. I was very humbled when I was asked to do this because we'll go through some of the biggest trends of the market, and we'll see that the US is the biggest market, but I think where we need more focus and more education is some in the global region. So I'm very pleased to see that there are other initiatives being taken globally to increase awareness of ETFs and of passive investing. So I have quite a few charts to go over, and we'll talk about in this presentation some of the biggest trends, not only from passive investing in general and what we're seeing globally, but also ETF products themselves. The universe has now gotten so large that there are products that really cover every type of asset class, every type of strategy that you can think of. And you can see that no matter what's happening in the market, there's always going to be some sort of product that's doing well. So the title of this presentation is ETFs in Focus, Insights on the Biggest Market Trends. And so for anyone, just to be clear, I'm going to have a lot of charts, a lot of data. Hopefully you find it informative. But if anyone is interested in finding this data, here's my contact information. Please feel free to reach out, whether you want the slides or just to talk more about anything that you found interesting from this presentation. I'm happy to chat. But let's go right into it. In the first section, I really want to focus on is just how ETFs are being adopted globally. And I know a lot of the focus tends to be on the US. It's by far the biggest market. It's about 70% of all ETF assets are in the US. But where I am now finding is that some of the biggest growth is coming from the international markets, from Europe, from Asia Pacific. So I think it's going to be really good to dive into how ETFs are being used across different regions or how they're being adopted across different regions. And there was this interesting survey that I just saw the other day, and it was conducted by WisdomTree, who's a big ETF issuer, and it's published on ETF Stream, which is a big ETF publication covering Europe. And I was very shocked by the data, and it was asking UK retail investors, what percentage of them use ETFs, what percentage of them even know about ETFs, And the survey only said that 22% of retail investors in the UK are using ETFs, which I found to be very low, considering that the UK is one of the more developed ETF markets in the world. But what was even more shocking was 19% said they never even heard of an ETF before, which to me was the most shocking data point. And that made me really think that sometimes we get lost in this world of covering the ETF industry, that we forget that sometimes we have to step out of that world and talk to everyone else and realize that maybe we do need more education, we do need more tools to get out there. So again, this is why I was so humbled to be able to do this, because I think that we need more of this, especially globally. But I thought that survey had some really interesting data, and I think this event is perfect timing to really support that. But let's start at the highest level, and then we'll sort of go down into more granular topics. But why are ETFs sort of popping up so much more now? The thing that we're seeing is globally, ETFs took in over $1 trillion. That's a record, $1 trillion in assets globally. And if we look at what's happening this year, it's on the same pace as it was last year. So I could maybe see another $1 trillion year in ETFs globally. But what I'm finding is a little bit different this year is US really sort of led the charge last year. But this year, more of the global markets are carrying the weight. So we're seeing Europe already on a very strong pace with flows, Asia Pacific on a very strong pace of flows. So we're seeing more of the growth coming from the other global markets. And you're seeing the ETF issuers start to focus on these markets now as well. Like I had mentioned, the US is much more mature. Issuers are looking to other markets that with the adoption of passive is much lower. And if we look at some of the rates of passive adoption in other regions, they're much lower than in the US. So globally, if we look at mutual funds and ETFs, we're at about 17 trillion in assets, in passive assets. I think that number can hit 20 trillion in the next couple of years. But as you can see by the yellow line, that's North America. They're almost about 40% of passive, of all funds, both active and passive. 40% are in passive funds. Europe actually has the lowest passive adoption of any region. It's only about 20 with ETFs and index funds together. Asia sort of in the middle. And we'll go into some of the reasons why Europe is a little bit slower with passive adoption, but it has to do with distribution and the way funds are being sold. But as you can see, passive is growing, and ETFs are very synonymous with passive, right? Most of them are indexed, or they track very broad benchmarks. So, ETFs tend to be the front of all this passive adoption trends that we're seeing. And if we look at this chart, I love, and it looks at, well, what's sort of passive adoption by country? And this is where it gets very, very interesting. So the size of the bubble is the amount of assets. And as you can see, like I mentioned, the US is really where most of the passive adoption has been. Things like focus on low cost fees, advisors being paid a percentage of assets versus commissions, more developed markets has really pushed passive to a bigger portion in the US. But specifically, there are countries that it's a much higher. Switzerland, for example, has very high passive adoption. Japan has very high passive adoption. But in general, Europe is only about 20%. So I think this number is going to continue to grow. I think as we see more and more education, more and more product come to market, more and more focus on low cost, I think this number will continue to grow. And not just only in Europe, Canada is still very low, China is very low. So I think that it's a trend that's starting to bubble up more and more. But I think this is going to continue to see these bubbles move over down and to the right, which is more and more passive ownership. Now, sometimes you might hear in the media or someone might mention, well, ETFs are getting too big. They're moving the market. They're distorting market prices. I want to put that to rest right now. And even though I had, sort of started this presentation with saying, well, how fast the ETFs are growing, and, they're taking in $1 trillion every year, et cetera. But if we actually look at percentage of all assets globally, ETFs are still very, very small. They're only about 15% of all assets globally are in ETFs. 15% is still pretty small. It's different across regions, so it's much higher in the US, as you'd expect. 20% of all assets are in ETFs. Europe is very small, 7%. So I just want people to realize when they hear all this news about ETFs, or these are getting too big, we're still at very, very modest levels of ETF adoption. This number will continue to grow, but I think it's important that we put this in context, that ETFs are not yet this huge, market phenomenon that's moving, distorting prices. There's growing, which is really great, but it still, I think, has a lot of runway for growth left. And what I find is most interesting, and even last year, where we thought maybe the market was maturing, there's all these new issuers coming into the market now. So we had about 40 new entrants come into the market, the ETF market, for the first time. And they're going about it in different ways. Some asset managers are taking ETF of mutual funds and they're converting them to ETFs. Some are actually starting with brand new businesses. But the real takeaway here is these big asset managers, these are all US firms right now. You can't not have an ETF business. They're seeing the growth. That's where most of the money is. Mutual funds are losing assets. They're all starting to put together ETF businesses. And this is happening in Europe as well. There are still quite a few big firms that haven't launched ETF businesses yet that I think are eventually going to come into the market. I think they're going to have no choice whether or not they just need to expand their offering or offer different product structures. It's really interesting to see that all these big asset managers now have some sort of ETF business. And it just puts into context how many new products we've seen. There's so many. In the US, I saw 500 new ETFs have come to the market in the last 12 months. That's a lot of products. But you're seeing an aggressive push by everyone needing to get in. They're seeing that the flows are hitting record levels. They're saying we have to get into this business. There's no choice now. We've tried to avoid it for so long. And you have to understand from their perspective, they're not doing it because fees, right? Which is great for the investor. ETFs tend to be a lower fee product. But for the asset managers, a lot of them have been holding off. But nonetheless, it's a great time to be an investor in ETFs because products are so cheap, and as more and more issuers are coming to the market, it increases competition. It brings down the cost even more. And we'll get into this a little bit later, but when I had mentioned just cost right now, and that I think is really what's the biggest trend in ETFs. And you might see this debate between, well, passive investing versus active investing. And it's going to be a little blurry because now more and more of the ETFs that are coming into the market, they are active, right? Or they have some sort of active tendencies. So that debate is not really as relevant anymore as what's the most important factor, which is cost. And that's really what's driving the increase of ETF flows. And what this shows is, well, what percentage of active funds are actually beating a passive fund, right? And what's interesting is globally, most active funds underperform, right? Whether you want to look in the US or in Australia or whatnot, most of the active outperformance rates are low. And there's one of the main reasons is costs, right? If you sort of factor in costs, that number might jump up quite a bit, but really cost is what's been leading to a lot of the underperformance and why people have been going into ETFs. And then someone always asks, well, if all these outperformance rates are so low, why isn't adoption higher in these other regions, right? So we had seen that Europe is still actually pretty low, but active outperformance is very low too. And it has to come down to distribution, right? The way funds are being sold. And Europe still has sort of an old system that, you either have to go through your bank to buy a fund, or salespeople are compensated through commission to sell a mutual fund. ETFs don't have any of that. So until those barriers come down, I think active will still continue to hold up pretty well in terms of assets in these regions. But there's a lot of regulation focusing on cost now. So I think eventually, as there's more and more pressure on that, the ETF adoption could speed up very, very quickly if they start to take down those cost channels. But as you can see, active over time just doesn't have the strong performance rates that people had thought. And this is just another visual to the thing that I was saying is cost. And for an ETF investor, there really hasn't been a better time. This is the US, but there's also the same trend happening in the other markets as well. And this just goes back to 2016. But as you can see now, we're down to the average cost of an ETF is very, very cheap. And that's not just dragging down ETF costs themselves, it's dragging down all fund costs, especially index funds. But you're seeing more and more these asset managers, if they want to compete, they have to cut their costs. So the increase of ETF flows, the pressure on that cost is really sort of spreading through the entire industry, and we're seeing just the average cost come down of a fund, which I'd mention is a great time to be an ETF investor. You can construct very, very globally diversified portfolios for a very, very low fee. And this is what I wanted to show here is this cost migration is so powerful, right? And it had mentioned, even though adoption and the competition is lower in Europe than it is in some of the other regions, the cost floor is already there very aggressively. So what I'm trying to get at is, even through using Europe listed only ETFs, I can construct a global portfolio with equities, bonds, commodities for as low as 8 to 11 basis points. That's pretty incredible for a region like Europe. So you can create something very, very diversified. Just to give you context of how much even more aggressive it is in the US, you can build the same portfolio for less than 3 basis points. So a combination of all these ETFs for a very, very low cost. So this is what I was trying to get at, when it's, again, never been a better time to be an investor. I think we're going to see this trend continue to move into other regions, but what I like about this is I think Europe is already seeing what's happening in the US. And I think I've covered both markets, and it's interesting perspective because it's almost in a way I've seen the future through the US market. And I think the European market, while it's ahead in some things, is behind in other things. But I think that cost pressure is going to start to come over to the European market. Maybe not as aggressive in the US, but for sure, we're already seeing signs of it. And I think as more and more issuers come in, there's going to be a very, very big focus on cost. So again, great time to be an investor. You have access to a lot of different products at a very, very low cost. You can build a very, very cheap, diversified portfolio. So what I want to focus on this next section is the new active. And what we mean by this is, that line between active and passive is very, very blurry. And it's because of the new types of ETFs that are coming into market, right? And so people tend to think that ETFs synonymous are just with indexing, and they are. A lot of the first products that have come to market have been these very, very broad benchmark products, either giving you exposure to US market, international market, aggregate bonds. And that's where a lot of the cost pressure has come down, right? And so if I just show you back again this chart, most of these exposures that are so cheap, they're pretty generic, right? Global aggregate exposure, just broad commodities, right? This is what we sort of think about when we first think about ETFs, right? That to these broad benchmarks. But what's so interesting about this market, and as more and more issuers are coming to the market, they're not competing in that space because it's very, very competitive. You have big firms like iShares or Vanguard, who are some of the biggest asset managers and ETF providers in the world, have really sort of owned that category. So as new firms are coming out, they're looking for something that's very new, that might be specialized, that might be focused on thematic investing or an ESG, and I'll get into all of that. So that line about active and passive is getting much blurry because the products themselves are getting more and more active. But what I think is the big takeaway here is that there's an advantage to the ETF wrapper, right? And why is everyone going to the ETF? Like, people might ask, well, why don't they just launch this in a mutual fund? There's a couple key advantages to the ETF. And maybe I should have started with this earlier, but this is a good time to go over it. There's a few things. One is ETFs trade on the exchange, right? On a stock exchange. They trade throughout the day just like a stock. So especially in a time where markets are very volatile, people turn towards the ETF. That's a huge advantage, right? Whether they want to make a quick change to a portfolio, they decide they want to get out of this fund, the ETFs allow that. And so, we've even seen cases like in March of 2020 during the COVID height, some mutual funds actually had to close their doors and halt redemptions. You don't really see that with the ETFs. During a market sell-off, you might not like the price you're getting out at, but you can get out compared to maybe being stuck in a mutual fund where you can't actually get out. The other big thing with ETFs is transparency. You can see everything that they're doing. You can see their holdings. The strategy is very, very transparent. I just think in general, people prefer more and more transparency, right? And that's a big advantage. The ETFs, whether they're index, even the active ones, you can see what they're doing every single day. And the last thing, this is more of a US advantage, but ETFs are very tax efficient. Now, they do have some tax advantages in certain regions in Europe, but it's not a general blanket term like there is in the US. But one of the big drivers in the US for this growth is that they're much more tax efficient than a mutual fund. So that's what's really been one of the also big key drivers of the growth in the US market. But let's go to more of these strategies and what I mean by new active. And what this shows is, I had mentioned sort of the plain vanilla, we'll call those the sort of generic exposures. Those launches used to be very, very popular during the earlier stages of the ETF market. But those have sort of faded away, as you can see by the blue line. And what's been popping up now is, so what I put in this category of new active is active ETFs themselves, thematic strategies. So, trying to take advantage of global changes like demographics or robotics, cybersecurity, innovation, ETFs like that. ESG, which is environmental, social, and governance. So ETFs that are investing in companies that have very, positive, environmental practices or governance practices. That's a huge trend, especially in Europe. And then smart beta or factor investing. So value stocks, cheap stocks, high quality stocks, momentum stocks. As you can see, these launches have really come up very aggressively in the last couple of years. And it's going to be so important that you as ETF investors, you have to really make sure this requires more work. And I think this is why it falls on the industry or analysts or everyone to sort of continue to push education, is that as more and more of these launches are coming to market, it's going to be very important to understand what the product is doing, right? So there's a lot of them that are coming. They might sound on the surface that they're doing the same thing, but it's important to really dive into the product and really understand it, and not necessarily just go based off of a name and saying, oh, well, this is a value ETF. Well, that's true, but they're built very differently. So due diligence is very important. Understanding the product is very important. And as we saw costs coming down, as that gets saturated, the other focuses now need to be on understanding the product itself, because cost has really been commoditized, right? They're so cheap, but choosing the wrong product or a different product can actually give you a very different experience, regardless of what the product costs. So it's good for ETF analysts because it keeps us very busy. But as you can see, the products that are coming out are not really your traditional sort of smart beta or plain vanilla products anymore. So it goes back to why issuers are launching all these different types of products and how they try to raise assets, right? And there's really sort of two things you could do. You either have to be very, very cheap, and that's what, again, the firms like Vanguard do. And this is what this chart shows is flows. Where do flows go? So being cheap is a big advantage. It's one of the few things that works in the market. But like I had mentioned, that is quickly saturating. Pretty much now, every single issuer in the world has a very, very cheap lineup, whether it's iShares, Vanguard, Amundi, State Street. Everyone now has a lineup of very cheap core products. That's quickly becoming less of an advantage. The other side, which is over on the right, is something we call shiny objects. And this is performance, really a product that might stick out performance-wise or be very conducive to something that's happening in the market. So I think a perfect example is these ARC innovation funds. People might be familiar with them, but really a couple years ago, the performance was very strong, was one of the best performing funds in the world. And that sort of led to a lot of inflows coming in. So what you're seeing now is more and more issuers, again, it goes back to the product trends that I showed. They're trying to launch products that are going to try to perform very, very well, which means that maybe they're much more concentrated, or they have very high conviction bets, or they're very high turnover. They're all really trying to find a product that's going to stick out performance-wise and get everyone's attention. And the other one is in the middle. Middle is a little bit of a tough place to be. So, funds that maybe don't want to deviate too much from a benchmark or want to do something too different. That's been a little bit tough. So what we're seeing is where investors tend to gravitate to is being cheap on one side and being very different or a good performer on the other side. And it's almost like a barbell, and that's how they're starting to construct portfolios. And that's the trend that we're seeing in product launches as well. And this stat, I think, is very, very interesting. And it looks at percentage of ETFs that are active and passive. And this is why I think it's so important that this active passive debate we have to look at it through the ETF lens as well. So if you actually look at last year, 60+% of the ETFs that were launched in the US were active in themselves, right? And so you can see that the active debate is now being brought over into the ETF. It's not necessarily, well, it's mutual funds versus ETFs. One advantage that active funds have by launching in the ETF is, one, the cost can come much lower, which is what we had mentioned. That's one of the biggest reasons why active was underperforming passive over the long term. This, again, great for an investor, meaning that cost even of active funds, even if you want to use an active fund and you really like an active manager, a lot of them are now launching their own ETFs. That's bringing the cost down. That's really great. The other thing is tax efficiency. Active funds in the US have found that we can now launch a similar strategy in an ETF wrapper and make it more tax efficient. At the end of the day, I think it really just comes down to choice, right? You have investors that might prefer a mutual fund, or they don't really want to care about trading as much, right? And they don't really want to trade intraday with the ETF. They can buy an active fund. Some might do or they can buy an active mutual fund. Some might really prefer the ETF and they want to be able to trade it. They want to see intraday what's happening, so they can now buy this through the ETF wrapper. Again, the number of choices is so great. And as we see now, we were sort of looking at these active and passive rates in mutual funds. I think as the market grows, we're going to start to apply this similar type of analysis to ETFs. And I have some very interesting stats that I can show later on. But it's important that you understand that not all ETFs are necessarily just passive. There's more and more of the interesting strategies being brought in. It's important that we really dive into the products and understand we know what they're doing. But again, great, you have a lot of choices, a lot of new products coming to the market. So ultimately, I think it's a really good thing, and I do like the competition of more products being brought into the market. The other thing is people themselves are active through trading. So what we mean by that is this also goes back to some of the critics I was mentioning about ETFs being too big, or they're taking over certain asset classes. But what we find is a lot of people just will trade passive ETFs themselves, meaning they might use different sector ETFs to make a bet, or they might use different fixed income ETFs. So even though an ETF itself might be passive and tracking an index, an investor might use those ETFs very, very actively. And I think this chart really sort of shows it all. And this shows volume, right, and number of trading of ETFs. And where ETFs really tend to stand out is when the markets are really volatile. And that's what that big line over on the left shows. That was during COVID of March 2020. That was a record amount of trading in ETFs. The market was very volatile. People wanted to make changes, or they wanted to get out of a fund. They turned to the ETF very, very quickly. And it's not just investors. Mutual funds use ETFs. Hedge funds use ETFs. People are seeing the benefit of a liquidity vehicle like the ETF, and they're using it. And now with some of the recent market volatility, we're seeing that trading has also picked up quite a bit. And what I think this ultimately does is it shows that the ETF can live through different market environments, and not just one asset class. There's equity ETFs, there's fixed income ETFs, there's commodity ETFs. So it's really great that we're seeing volume pick up. And what was very interesting in March 20, there were a lot of articles that had come out saying, well, the ETF was broken. There was fixed income ETFs weren't doing what they were supposed to do. There was a disconnect between prices and what their net asset value was. But I think what is the telling sign is even post that, people continue to trade ETFs. they're continuing to allocate to its ETFs. I think that's always the ultimate sign that the market themselves, investors are smart, that if they don't like a product and they don't want to use it anymore, they're going to stop allocating to it. And we've seen cases of this before. If they're dissatisfied with it, they'll stop. But the fact that flows are still very good and the trading is still very good shows that they prefer the ETF. Again, for the similar reasons I'd mentioned already, liquidity and whatnot. But it's important to also know that not only can you buy active ETFs or smart beta ETFs, people can be very active by trading passive ETFs themselves. And we see that quite a bit as well. And with all the new products coming out and all the new exposures, it gives you more options as an investor. Being able to trade different exposures, take a viewpoint on something, and people can even go long or short these different ETFs. So there's endless possibilities of what you can do with it. But I think it's also really important that one of the most popular ways they're being used is active themselves, people trading it or institutions trading it. So for example, in Europe, it's a very, very heavily institutional market. So institutions love to use ETFs to put in their portfolio or to manage exposures through it. So there's a wide array of users, not just retail, but institutions, funds are all very, very active players in the ETF market. ESG is one of the biggest trends that we're seeing in ETFs, specifically Europe. And there's a couple areas in Europe that I think they are much further ahead than other markets. And one of them is being ESG. So what we mean by ESG, again, I mentioned it's environmental, social, and governance. So really what these ESG ETFs try to do is own companies that are doing well from a social perspective, or trying to reduce carbon footprints, things like that. So as you can imagine, they tend to not hold big oil companies or some of these other names. But what was a big change in Europe about a year or so ago was this new regulation called SFDR. And what this did is it now required funds and ETFs to say, well, how ESG are they? Are you not ESG? Are you sort of a little bit ESG? Or are you very, very aggressive ESG? So they call them Article 6, 8, or 9. And because of that, most of the new products that come into the market in Europe all have some sort of ESG mandate. About 50 to 60% of the new launches have some sort of ESG mandate. So there's a lot of choices from the ESG front. Now, it's very important, the definition of ESG and how people define it is very, very different across products, across index providers, because some might view this company as ESG, others might not view it as ESG. So it's really important to you as an investor to understand what the ESG process is for these ETFs, and take a look at what companies are holding, or even more importantly, what companies are excluding from these ETFs. I think this trend we're going to see in the US, because the regulators there, like the SEC, is now starting to mandate that companies be more transparent in their disclosures about what they're doing on carbon or on climate, whatnot. I think we can potentially see this type of similar type of classification in the US. Again, ESG is very sort of the biggest market now is Europe. So on average, all the monthly flows that come into ETFs, anywhere from 40 to 60% are going to an ESG product. A lot of it is because, institutions have to have some sort of ESG mandate, and they're naturally gravitating towards, these types of strategies. But what's interesting about ESG is the ETF has been the forefront of this growth. A lot of the ways institutions are getting this exposure, or retail, is through the ETF. So this is what's so great about the ETF. It can really adapt itself to anything. Now ESG is a big focus in Europe, and people are implementing those ideas through the ETF. So the ETF, again, has really been one of the leaders in this ESG push in Europe. And it's not quite as popular in the US, but I think we're going to see it more and more. Now, about all the ETF assets in Europe, about 17 to 20% are in ESG. That's only about 2% in the US, but I think that number is going to increase very, very aggressively. Thematics is one of the most interesting areas. And what we mean by this is sort of so we have to look at it in the context of how people define sectors, right? So we know that there's companies like technology companies, oil companies, things like this. What sector investing did, and before it got very, very popular, is it sort of tried to break down those definitions, right? So, for example, they were first in saying, well, let's launch cannabis ETFs, or let's launch cybersecurity ETFs, right? These were products that didn't, or sectors that didn't really exist. They sort of define these sectors themselves, and they've been by far one of the most popular areas of investing for investors, right? And again, I think what really put these products on the map were these ARK funds. And this was run by a portfolio manager, Kathy Wood, who was trying to find disruptive companies, right? And Thematic falls into that category. And what I'm showing here is this is all the different categories of thematics that we have in the US. There's so many. Now Thematic is actually, I think, the single biggest sector in terms of assets for ETFs. And they're becoming very, very aggressive in Europe as well. And I actually like thematic investing in Europe a lot, because when you look at investing across different countries, we have a different problem in Europe than we do with, say, in the US, that you have all the different countries, you have all the sectors within the country. Thematic is interesting there because it breaks down all of those barriers, right? Across countries, across sectors. It's really just trying to find innovative companies, not just in Europe, but globally. But now, for the first time, investors in Europe have access to all these different types of strategies. And I remember when this ARK craze was going on, the most common question I was getting was, can I buy this in Europe, right? Can I buy the same type of strategy in Europe? Now, retail investors, it's very hard for them to buy US products, but during that time, there was a whole flood of new thematic products coming to the European market. Some were innovation, some were all different types of sectors, but there is clearly a very, very big interest in thematic investing. And this goes back to that chart I had shown about the cheap versus good performers, right? And thematic is really sort of trying to fall in that shiny object lane. Is they tend to be very, very concentrated. They tend to be much more niche in their focus. But this is, I think, what investors want, right? You want different companies that aren't necessarily being picked up in some sort of broad index fund. So, for example, if you're already owning a broad benchmark like the S&P 500, I don't want a thematic ETF to look the same way. I already own these companies in this fund. So when you're looking at thematic ETFs, I think it's very, very important to make sure that the exposure you're getting is maybe different than what you already have. And I think this is the right way to look at it. And thematic ETFs tend to be a little bit more expensive, and that's okay because they are more specific in their nature. They're more niche in their nature. It's okay. You know, what you'll find is with all those ETFs I was showing, the specialized ones, they tend to be a little bit more expensive. Again, that's okay if you couple it with the cheap exposures on one end and the thematics on the other end, or any of these new active ones on the other end. You're still going to have a very, very low cost portfolio. But paying up for sort of unique exposures is okay. And this is where I think it's important when you're looking at a thematic ETF, understand what you're paying for. Understand that, one, is this different than the stocks or whatever exposure I already have? And then two, is it actually giving me exposure to that actual theme, right? So sometimes if you look through this, you might just find companies that you already know, or the very big companies that maybe aren't really giving you exposure to that theme. So I think purity is also very, very important. But this chart just shows the assets, right? And you can see really during COVID, they got very, very popular because themes were really a good way to play what was happening, what was changing. For example, work from home became a big thing after COVID, right? Everyone was working remote. There were ETFs that came out that were trying to take advantage of working from home. So they're very, very opportunistic. And as you can see, as things have changed, you see if there's even one category there, work from home or travel, things like that. So sometimes when the market allows for it, you can see that people will flood into these products to take advantage of what's happening. But nonetheless, thematics is probably one of the fastest, if not the fastest growing category, and it's probably the area that I honestly will get the most questions from, because that's where most of the product innovation is happening, and I think that investors clearly are very, very interested in learning more about thematics. Now let's look at the whole universe of new active and why I really wanted to hone in on the point of this active passive debate. And when we look at, if we take this category of new active and we actually look at it compared to the S&P, you can see that performance varies as well, and why it's so important to pick the right product. So as you can see, in 2020, thematics were doing very well. That's what that white bar shows on the left. That 75% of the thematic ETFs were beating the S&P 500. But now with some of the recent market volatility and some of this, that number has dropped, right? But then you sort of see that during different periods, different things tend to do well. So now, for example, we're seeing smart beta and factors do very, very well. Active funds are doing very, very well, while ESG is not performing as well. But this is what's so great about the ETF. There is so many products. So globally, there's almost 10,000 ETFs across all the globe, 3,000 or so in the US, another 3,500 or so in Europe. So there's always something that's working. And that's what's really great as more and more products continue to come into the market. There's always going to be something that's working. There's always going to be some sort of market environment that's going to benefit a certain amount of ETFs. And right now, what's working is smart beta. And this is one of the other new categories that we were looking at. And what we mean by smart beta, it's really factor investing. So it's trying to buy cheap value stocks, meaning stocks that you can buy cheaper than what the market is pricing, or high quality stocks that have really strong balance sheets or a lot of cash on hand, or momentum stocks that are trending well from a price perspective. There's all these different ETFs that allow you to benefit from that. But now what we find is when markets are really volatile, smart beta and factors tend to do really well. So for example, now value is doing very, very well. Very low priced companies or cheap companies relative to what the market is thinking have been performing quite well. But this is why it's been so great to cover this industry, because there has been so many new products coming to the market that are covering everything. And now we're seeing a lot of these themes start to commingle. So for example, we see factor-based ETFs with an ESG screen, or we see active factor ETFs, or thematics that now incorporate ESG. So pretty soon I'm going to have to update this chart, and now these lines are starting to even mix in themselves. But this is what I love about the industry, that the issuers are constantly pushing the envelope for innovation. And I think we're going to, as more and more come in, we're going to see even newer frontiers being broken down. And that's one of the areas I want to look at next, is fixed income. When we look at the market in general, it tends to be very equity focused, meaning ETFs. So most of the assets tend to be focused on the equity side. Fixed income, just because of its nature, it's a little bit more difficult to index. There's no exchange for fixed income like there is for stocks. Most of them trade over the counter. Indexing is a little bit more difficult in fixed income. But that is starting to get much better, right? There's more and more research coming out. There's more and more tools coming out that's going to make fixed income investing, especially from an index perspective, much, much easier and much better and much more efficient. And when you look at, we mentioned those trends about active and passive. One area that hasn't really been disrupted as much through the ETF has been fixed income. Active funds tend to have a pretty strong moat in that space. Again, for some of the reasons I mentioned, it's a much more fragmented market. It's a little bit harder to sort of index and cut through there. So they've been okay from sort of the threat of ETFs taking over, as much as where active equity ETFs have a really strong foothold over there. But a lot of the innovation that I've been seeing is on the fixed income side. And it's an interesting time now, right? With rates coming up and inflation, I think investors are going to be expecting more and more tools on the fixed income side, whether it's through the use of derivatives or trying to generate more income or just trying to, downplay the effects of inflation. this is a very interesting time for fixed income. Maybe people might not love the asset class right now just because of rates going up, but I think we're going to see a lot of innovation coming into the market. And these fixed income asset managers have sort of been immune again from the growth of ETFs. Now, I think that window is shrinking, and we're going to see a lot of the future innovation we're going to need is going to come from this area. And let's just talk lastly about due diligence, right? And there was this very interesting survey that had come out, and it was asking investors across all the different regions, what's most important to you when you're picking ETFs? What do you look at? What's the biggest focus that you put on? And we'll start on the left in the US, and I had mentioned cost, right? Cost, as you can see, is the second highest ranked thing. It used to be 1 last year. That's what the number is next to it. But as you can see, cost is a very, very big focus in the US. Most of the, when I talk to a lot of investors, a lot of them just say, well, what's the cheapest product or what's the biggest product? That's fine. But I think it's important to keep yourself open, because there are a lot of products that might necessarily be the cheapest or the biggest, but they're very interesting and they have very, very interesting methodologies or very, very interesting exposures. So all I would say to you is don't just be quick to dismiss a product because it's not necessarily cheap or it's not the biggest. There's some very interesting things that are happening, especially from the smaller ETF issuers that are really pushing the envelope for product innovation. So it's important you got to look at all this different criteria, but don't necessarily just screen out something because it's cheap. And the other thing that's important in the US, and I think it's true for everyone, is just the reputation of the issuer, right? You want to make sure that the issuer who's bringing these products to market has been around for a while. They have a good reputation. They don't have a history of wonky products that are closing or have problems. So that's very important too. But if we look at in Europe, what's most important, and it makes sense, is trading volume, right? And I'd shown the volumes picking up earlier, people using ETFs. But Europe is very fragmented, right? There's all these different countries. There's so many different exchanges. Sometimes it's hard to know what's the true liquidity of the ETF and where is it trading. So it's important. There's a lot of great tools that are coming out that are giving investors a better look at how ETFs are trading. But that's one of the most important things to a European investor is the amount of trading. And it's great because the volumes are going up. So you're seeing that European investors are very much more comfortable with trading the ETF. But as you can see, the other thing that's important to them is the brand of the issuer, right? Again, a lot of the issuers that are in the US are in Europe as well. But then there's also the European specific firms, and they, as you can imagine, tend to do better in terms of asset raising and awareness in the local market. But I would really implore everyone to take a look at this chart as well, and just look at what are all the different things you can look at when you're picking an ETF. Again, cost and all that, we know that. But then as you get further, it's important to also look at the index methodology. What's the actual ETF doing? That's probably one of the most important things. What companies is it tracking? How many companies does it own? How often does it rebalance? Those are all very, very important criteria when you're picking an ETF, especially if costs are coming down and they're all essentially the same. Where you're going to get performance differences is not from cost, it's going to be from exposure differences or the ETF having different companies than this one, even though they might sound like they're the same strategy. I think that's where most of the important focus needs to be on, is on understanding what the strategy is doing and making sure it's within the constraints that you want. So the other thing is tracking error, right? And it's okay. Some investors don't want to take on tracking error. What I mean by that is they don't want to look too different from a broad benchmark, and that's fine. Some want to keep it much tighter. They want just a little bit of value or a little bit of this, which is fine. Others might be willing to take on more exposure. Well, I don't want watered down value. I want something that's very, very aggressive. There's ETFs for all of that. So obviously the missing piece here that we don't know is what are your goals, right? And how are you constructing a portfolio and how all that factors in. But I think this is a very great survey, and it really shows what criteria needs to go in when you're analyzing an ETF. It's stuff that we look at also every day as ETF analysts. I think it's also important that investors look at it themselves. With that being said, I just wanted to thank everyone for listening in and attending. I hope you found this informative. Again, I love this initiative of trying to raise awareness of ETFs and passive investing globally. Thank you to the Warsaw Passive Investment Conference for having me. I hope you found this informative, and everyone have a great day.
Szanowni Państwo, teraz czas.
Ladies and gentlemen, yet another point in our agenda now. Now we'll answer the question why index investing is becoming ever more popular. Przemysław Gerszman is going to be our moderator. With him, Alexandra Pluj and Ephraim Slen from NASDAQ.
Hello everyone. Thank you so much for joining us today. My name is Przemysław Gerszman and I am your host. Today we have an amazing panel on why is index investing gaining popularity, where we will be talking about the big trends we need to keep our eyes on. We have two fantastic panels. Alexandra Bluy, Deputy CEO of GPW Benchmark, and Ephraim Slen, Vice President, Head of Index Research, NASDAQ. Before we dive into the questions, we will take a few moments for each of our two panelists to briefly introduce themselves and tell us a little bit more about their background in the industry. Alexandra, would you please tell us something about yourself and the company?
Well, I will start with the company. GPW Benchmark is the part of the Warsaw Stock Exchange Group, and we deal with the indices. Actually, we are the licensed administrator of the all week indices. We provide also the interest rate benchmark, which is the VBIT and VIBOR rates. We are actually at the very moment analyzing and almost providing the risk-free rate benchmarks for the interest rates sector. We are also planning to launch a lot of new customized offer, namely the offer for the general sector and for the mutual funds, for international funds, in order to provide our clients with a customized offer. So, and I am the actually deputy CEO of the company, and I'm responsible for the benchmarks methodology and the increase of the offer of the indices in Poland for the Polish market and for all the indices and for all the businesses that the Warsaw Stock Exchange is actually dealing with and providing.
Thank you. Ephraim, please tell us something more about yourself and your role at NASDAQ.
Thanks. Glad to be here. So my name is Ephraim Slen. As you said, I'm the global head of research for NASDAQ's index business. I've been here over 11 years, been in the ETF indexing space just under 13 years. So really been a part of the space for quite a while. Very excited to be here to talk today about why index investing is gaining popularity. In a couple comments on NASDAQ's index business, right? We've been in existence technically since our exchange launched back in 1971 with the launch of the NASDAQ Composite. And today we actually calculate over 45,000 indexes spanning asset classes and thematics and all kinds of fun stuff that I'm going to be talking about today. Thanks for having me.
All right, thank you. So let's jump straight to the first question. Why is index investing gaining popularity? That's our main topic of our debate. How would you define popular? And is index investing already popular? Please go on this first one, Ephraim.
Happy to. Again, I kind of feel like it's an honor to be here to talk about that. So if you think about the space and even going back to, decades and decades ago, so indexing really started back in the late 1800s with Charles Dow. Fast forward 70 years, the S&P 500 was launched, and I mentioned before the NASDAQ Composite launching in 1971 with Jack Bogle, which again, we'll probably talk about, I'm sure later today, right? Pushing the bounds of index investing. If you look at what's occurred from the mutual fund space and all the index funds and the dollars tracking to what's occurred in the ETF landscape, when I think about popular, I think about dollars tracking and awareness and benchmarking, and thinking about what people are doing and how they're actually looking at what is actually going well for them from an investment perspective. Again, that's what benchmarking is, right? How do you see your performance of whatever it is that you're actually purchasing? How is it doing? And then from actual dollars tracking, truthfully perspective, right? Are you buying and investing in products, and what do those look like that are truly tracking those benchmarks? So if you think about indexes like the S&P 500 that of late have over $1 trillion just in 3 U.S. listed ETFs from Spider, right, from Vanguard and from iShares, just here in the U.S. it's around $1 trillion just in those 3 products. So there's a lot of money tracking indexes in the world. And then even thinking about from a dollar tracking perspective, an ETF landscape just passed $10 trillion. This past year was a record milestone globally for the ETF industry, with over $1 trillion of inflows. Again, sure, some of that is not index based, but the majority of it is.
All right. How about our local Polish perspective? Alexandra, would you go on this one?
Yes, of course. Thank you very much for Efrem said, because this is very important for the perspective of the company, of the market that is actually following the big market. The story of the Polish indices is not that long, actually. If we take a look at the WIG, we need to remember that the WIG story started in the 1990s, and the offer of the indices for the Warsaw Stock Exchange was only 3 indices, and it has been expanding through the years until today's something, together with the customized indices, is actually almost 50 indices, including our plans to build up the more cross-sector indices for the market in order to make this opportunity, to give the opportunity to invest in bigger group of the companies. But if index business and index investing is gaining popularity, I need to say that yes, it does, but in Polish case is a very slow pace. Why am I saying that? I'm saying that mainly because we are observing a growing interest, especially in the total return indices, as regards our contacts with the mutual funds and with other institutional investors. But as regards the offer of the instruments, especially the instruments, index instruments for the passive investment, the Polish economy and the Polish products are actually at the beginning of this road. We have seen the increased popularity of investing in Warsaw Stock Exchange among the individual investors, but as regards the indices and as regards the passive investments, in my humble opinion, there's plenty to be done. And our task as the GPW benchmark is to communicate and is to open the new phase of the communication with the market, which in my humble opinion means thinking in a kind of futuristic way about what the investor would like to see, what kind of indices investor would like to invest in. So from the point of GPW benchmark, yes, we do see that the indices are very popular, because if you wake up in the morning, you need to know what is going on the market is the easiest way to follow the WIG or WIG 20 or MWIG 40, which is very popular also as regards to passive investment, mainly the ETF being available on the Warsaw Stock Exchange. But investing, there is still plenty to be done.
Oh yeah, that's true. But the main question from a perspective of individual investor is, what are the biggest advantages of index funds and how individual investor benefits from them? Efrem, could you please tell us something about these advantages and these benefits?
Certainly. So there are three that I really think of that come to mind. So the first and foremost that people tend to think of when it comes to investing, it's cost. So when you think of index funds, generally they are low cost vehicles that track indexes. Number two, it's tax efficiency. And number three, and this is when it comes to exchange traded funds in particular, it's access to intraday liquidity. And so if you go beyond just ETFs, and the overarching element here is it's access to the markets and being able to invest in a way that you're gaining exposure to sectors of the market that you're looking to track. Now, that could be the VIG 20, it could be the S&P 500, it could be the NASDAQ 100, it could be the MSCI EFA, it could be the Nikkei, right? It could be anything that you're trying to gain exposure to in an index fund wrapper.
All right. How about Polish market? You said before, Alexandra, that it's gaining a mass really slowly, but I think that the index funds are helping Polish investors to just jump on board and reap some profits of the market.
Yes, of course, I totally agree, because it seems that when we all talk to our friends and to our business partners, and if we talk about the individual investor, this is the investor in Poland, I believe, that he really knows quite well what he would like to invest in. But what is important is to attract other people in other clients that they do not have this kind of knowledge and they do not follow the fundamentals so well. So in order to make the financial and capital market available for the clients, we believe that investing in indices is the proper choice. Why? Because the entry barrier is quite low. You don't need to follow all the company's news. You need to understand that if you don't want to put your money in the socket and you don't want to put your money under the pillow or put it into the bank account, you have a choice. You can give it a chance in the long term or medium term and to choose the basket that has been chosen for you by the professionals. And by professionals, I mean not only the administrator, because this is not only the administrator that evaluates what is important and produces index after index in order to make you confounded. Chosen properly by the professionals, I mean chosen in a way that it is being discussed with the institutional investors, it being discussed with the market participants, and it being discussed with the intermediaries on the financial and capital markets. That is why I believe that index investing might get popularity if we all understand that if you choose one basket, it doesn't mean that you need to choose one basket and only one. You can choose several ETFs, you can choose several passive investment strategies and manage your portfolio properly. In that case, we can offer the ETFs that are concentrated on the mid caps, for instance, very popular. We can offer the ETFs that has been, for instance, following the bond market, and there is a ETF on the Warsaw Stock Exchange being traded and responsible for tracking this sector. But also we can create also the index that might be a little bit futuristic and concentrate on something more promising that the investor might find interesting for the future. For instance, ESG tracking companies, or something much more interesting, not available, maybe not available because there are ETFs for the global markets available on the Warsaw Stock Exchange. But we need to understand what I want to say, that to diversify portfolio doesn't mean that you need to take only one ETF, and index investing gives you the opportunity to create your business strategy, including something that has been already chosen for you and packed into the baskets.
So what you are basically saying is that when someone says something about passive investment, it doesn't actually mean just buy something and hold it forever. It means
it doesn't mean buy and forget. That doesn't mean buy and forget. It means that you can buy, and then you don't have to buy and invest all your money in one index. You can choose the basket from one for one sector, and then from GPW benchmark, for instance, for the index for the Polish market, and then go to Ephraim and take some of his offer in order to have the maximized portfolio diversity. So the index is something that gives you the exposure to the basket of the companies, but it doesn't mean that you need to concentrate only on a couple of them.
Oh, yeah, I think that's really important. Ephraim, could you confirm that that's how you invest in America?
Absolutely. Look, everyone has their own sense of how they look to invest and put their money to work. What's really interesting, especially with the advances of the ETF markets, is I use the word access, and I'm probably going to continue to use it because that's what I think of when I think of what you're able to access that you just couldn't gain access to before, right? When it comes to investing in the U.S., you look around and you say, all right, if I want to gain exposure to the U.S. equity markets, I can via all these types of wrappers. If I want to complete my portfolio to try and get this type of risk return profile, if I layer in this fixed income instrument or this options overlay instrument or this sector strategy or this part of the world, right? I want to gain exposure to certain European countries, right? I want to gain certain exposures to certain Asia Pac countries. Maybe I don't want the whole thing. Maybe I want the whole thing. But you're able to gain that access via these products.
All right, now I would like to ask Ephraim something about the history of your market. I'm definitely sure that you know this gentleman, which is John Bogle, the guy who probably invented the index fund industry. Some say that thanks to him, millions of investors around the world can now pay very low commissions for the opportunity to invest in the broad stock market. Has Bogle actually had such a big impact on the index fund industry? What's your opinion?
I mean, you have to say he has. I mean, there is just too much money, right, with Vanguard. It has just been too much a kickstart to the whole world when it comes to index investing and products tracking indexes. So there's no question there was a seismic shift that occurred as a result of everything that he started. And again, that started really in the mid 70s. I was just watching a video of him last night talking about how he got things going, and it's a pretty incredible story for those that are interested, right? Like show the book. There are so many books that continue to come out. Eric Balchunas put one out from Bloomberg just recently too. So there's so much that you can read about the space and how it's evolved. I'll give an anecdote that's close to home for me, given here at NASDAQ, right? So looking at the NASDAQ exchange, I started out before when our company even started with the exchange kicking off in 1971 with the composite. That was a way to track all the stocks listed on our exchange. If you fast forward 15 years, we launched the NASDAQ 100 in 1985. That's really the barometer of the 100 largest non-financial companies. So when people tend to talk about the NASDAQ went up, the NASDAQ went down, they're talking about the composite. But the NASDAQ 100, that's where most of the dollars that are tracking our index that have actually been put to work. In 1999, the formerly actually NASDAQ 100 tracking stock, NASDAQ launched that ETF. We since sold it off to Invesco. It's called the Invesco QQQ ETF in 2007, and it actually crossed $200 billion at the end of last year. Pretty incredible phenomenon to have that type of investing occur just in one benchmark. And again, I was even thinking about it going into this webcast. I've been here over 11 years. When I started, the ETF had around $20 to $30 billion, and it wasn't anywhere near what it's been today. And that's when I think of, what did John Bogle bring to bear? What does index investing turn to? And I really turn to the NASDAQ 100, something that's so close to me, and how it's just evolved tremendously, right? So that's just the ETF here that's listed in the US. There are hundreds of other products globally that track the NASDAQ 100. There are derivatives with futures and options. There are overlay solutions. There's so much that's been put to work in a way for folks to gain access to the NASDAQ 100. Again, that's what it's all about. It's a way for you to track a sector of the market. Again, in this case, it is the NASDAQ 100. But again, I go back to even the premise of the question. Did John Bogle jumpstart the industry? There's no way he didn't. There's just too much money that Vanguard has tracking to say that he wasn't a massive player and possibly the godfather of index investing, as I've heard many call him.
Oh yeah, Godfather. That's a good name for John Bogle. But I think that even Warren Buffett, who is still with us today, he's an evangelist of index funds and of passive investing. He said something like 90% of investors should just go and buy index funds or something like this.
Yeah, it's such an easier way to gain exposure to the marketplace, right? You don't have to put your ear to the ground and think about what are you trying to see in what the market's doing, you can just go and buy an index that's tracking it all already. If you want to gain exposure to the U.S. large cap space, you can just go buy the S&P 500 or any, frankly, barometer that more, super large cap barometer that folks are looking at. You can buy the NASDAQ 100 tracking products. You can go buy the Russell products. You can go do that, right? That's a way to gain exposure to the U.S. markets, right? That's it without having to do any work, right? There's no homework necessary. They're literally doing all the work for you. That's the incredible thing here about buying index investing, index funds and products that track indexes, right? Is that you don't have to worry about rebalancing. You don't have to worry about corporate actions. You don't have to say what actually went in and out. Did a company fall to small cap? Did a company fall out of developed markets or out of emerging markets? You don't have to pay attention to any of that. The fund administrator does all of that for you. They're doing all the tracking of what the index is doing to bring those products to bear for you. So again, that's why I'm a huge believer in the space and why I believe in it. And the funny thing too, former colleagues talked about this too, is we're talking about passive so much here today, and that's what index investing is about. But so many times people make active choices of passive investing. So here in the United States, we have retirement plans that they actually even take that part out away from you. Is that every 2 weeks, or depending upon what your company might offer, literally the dollars come out of your paycheck. Like that is as passive as it gets. For getting passive funds in a passive way. So every 2 weeks, you're frankly setting it and forgetting it.
Well, and can I add something to this? Because I would like to also to make people understand that indices are not something that is actually, it's true what Ephraim said, that the client doesn't need to actually concentrate on the corporate actions or anything that happens or kind of revisions of the indices, because everything is done for him. But it was also important that I know that the smart beta indices are not so easy to manage from the point of view of ETF. But if we take a look at the indices sector and the indices business on a way that we can gather in this CARP, in this group of companies, something that is very specific, that is something that catches some idiosyncrasies of the companies that you would like to invest in, and that this kind of index is being produced, you can get exposure to what you believe in some respect. For me personally, this is the very promising spectrum of action for the ESG related businesses and for the ESG related indices, because what is important nowadays is to, in the respect of ESG segment and ESG factors, is to choose the companies that are investing and are running the business in a compliant way with the ESG factors. And for the client, for the individual, it is very difficult to understand and to evaluate the information regarding the ESG factors being treated as by the company. So in my humble opinion, indices can be the answer for the kind of futuristic businesses and make easier for people to understand that they are investing in something they believe in and they would like to invest in. But this entry level, as I said at the beginning, and the entry barrier is much lower.
And if I may too jump in on top of that, that was a great point. Just thinking about indexing too, most indexes are rules-based transparent. That's one thing that we haven't touched upon yet. Rules-based transparent, meaning you line up a set of rules. This is exactly the way the index is supposed to fashion, right? There's a minimum market cap, there's a liquidity rule, right? There might be a rule for trading on an exchange for a certain amount of time. It might need to be listed on certain exchanges, need to be listed in a certain market, a certain cap size, right? You got on the list, boom, 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 right? You're able to get in. If you don't meet those criteria, you're not going to be able to gain, entrant into the index. And actually, it's a key component of the NASDAQ 100 in particular, but it's important to understand methodology. Now, not everyone wants to necessarily get in the nuts and bolts. Most indexes really are rules-based transparent, but some do have committees. Like that's a key thing I want to bring up, right? The S&P 500 has an index committee that governs exposure, entrance rather, to the index. And so if you look at a company like Tesla, it made it into the NASDAQ 100 at a market cap of around $15 billion in July 2013. If you fast forward to the end of 2020, when it finally made it into the S&P 500 as a byproduct of the S&P 500 committee, allowing it in, it had a market cap of $660 billion. Now, when people tend to think of the S&P 500, they think large cap. Now, that is a mega cap, mega cap, right? It was one of the 10 largest companies in the world when it made it into the S&P 500. And we really thought of that, Alexander, because you brought up ESG. And everyone has their own opinion of ESG, so it's important when you're looking to invest in things and indexes or otherwise to understand what it is that you're actually looking to gain exposure to, because you might have one opinion of ESG and what you're looking into might have a different, right? So at NASDAQ, we work with Sustainalytics, but as well as a number of other vendors. Again, I'll get into some of that in a bit, but that's kind of where, I'm thinking through here, some of your comments of, when you're looking into certain types of choices, that's the key thing here, is that understanding what is actually under the hood. How are the indexes actually being pulled together and managed and maintained?
Oh yeah, unfortunately in Poland we don't have anyone like John Bogle nor Warren Buffett yet. We don't have them yet, but because our market is quite young. But we have a GPW benchmark. So Alexander, the question for you is, how do you see the role of GPW benchmark in our market? Which products are you, in your opinion, are in the spotlight of investors, and what do you consider to be your greatest success?
Okay, so just to add something to what Ephraim said, we have two committees, Ephraim, for our indices actually. We have the Oversight Committee, because in Poland we are under the BMR rules, so we have somebody that is actually monitoring our actions and compliance with the methodology, and we have our advisory body, which is made of the professionals from the market, and we are actually consulting the changes of the methodologies and our ideas regarding the new indices with the professionals. So we have two committees, and yes, this is very important because the safety, the robustness, the transparency of the indices is something that the indices need to have. It's like the ID of the index. In order to, for me, for instance, the indices are worth as much as the trust, as the client's trust in those indices. So taking that under consideration, we need to make the changes and to make plans considering the indices very well understood in order to make people understand that it's worth to invest in those indices. As I said at the beginning, the total return indices, the total return VIG, are gaining popularity as regards our contacts with the institutional investors. And I believe this is not a surprise. But also what we would like to add is that we, for instance, we would like to concentrate on specific sectors and on building up the indices that are evaluating and following the segments of the economy. Apart from the VIG games, the new VIG games sector, for the gaming sector, we have launched recently the VIG 140, which is actually covering almost 96% of the companies being listed on the Warsaw Stock Exchange, and we believe that was a good hit for the client that would like to have the exposure for the total capital market in Poland. But nowadays we would like to concentrate on something like cross-sectoral, because in the sense of the Polish economy and the Polish stock exchange, we are not NASDAQ yet, and we do not have plenty of global companies being listed on the Warsaw Stock Exchange, but we have quite important names and quite important companies that might be attractive if grouped in a proper way. For instance, we would like to do the VIG financials, grouping the banks and other financial institutions. We don't have that yet. We would like to follow some parts of the economy connected with the industry, namely the real economy. So the companies that are adding the value to the Polish GDP growth from this side. I believe that there is a lack of VIG for the services, which is kind of an important segment for the Polish small open economy. But also e-commerce, that has been very interesting as regards the last 2 years IPOs on the Polish Warsaw Stock Exchange. So this is for the sectors, and something more than a small sector, something cross-sectoral, to give the opportunity to make index investing even more popular. Of course, the answer for the index attractiveness is not in the number of the companies, but it actually does. If you have the scope of the companies that are liquid, you can choose the replication method as regards the index investing and the ETFs as well. So we would like to discuss with the market. That might be a little bit of change. We would like to discuss and open consultations before we start to provide new indices in order to answer the needs and demand from the institutional but also individual investors. But what I really believe quite promising, and I have to say I disagree with some representatives of the institutional investor side, is grouping and creating the indices for the ESG. As Ephraim said, and I said before, it is very difficult to understand what ESG would mean and what ESG means for investing. Nowadays, we believe that ESG is a huge burden on the companies regarding the non-financial statements and non-financial information. Why is that a burden, and why do we believe so? Because for the moment, the scope and the reference point for the companies publishing this kind of information is quite limited. That is why it's also difficult to create a representative index for such companies. But isn't that the proper moment to start discussing the proper way to evaluate the plans of the companies that are being made for the moment? For instance, the companies that are reducing the cost of energy and fuels and carbon emissions, etc., in order to give the client, the new client, the modern client, the way to invest in the companies that in the 20 or 30 years would be already there. So they will be ESG compliant as we understand that today. I believe that the proper meaning of creating indices and for the index strategy is to answer the question about the future. So demography, ESG, and inflation. I believe these are the questions, and these are the question marks that we need to answer in creating new businesses.
The question about future is coming, but Ephraim, what is your take on ESG? What do you think? What's your opinion?
Quite a lot, I feel like, but just like everybody else, right? We had the joke with our colleagues, and we were really starting to get going, trying to see what was our ESG strategy. We said, if you put 5 people in a room, we're going to have 20 different opinions, right? Because there's just so many ideas. When you think of ESG, the first thing here is E, the letter E. Everyone thinks it's about the environment, exactly. But there's so much more than that, right? I mean, Alexander brought carbon emissions, right? That's a huge proponent of it, but there's still the S and the G, right? Governance is so important. The social is still so important, right? You can't just do one and not do the other. So here at NASDAQ, we've actually had some thematic ESG indexes that focus really more on the E element. They've been around for over 15 years now, looking at green energy, looking at the smart grid infrastructure. We've had them for quite a long time. We have indexes on wind. We had a whole index family that we launched right before I joined NASDAQ in late 2010 on the green economy. But they don't all necessarily touch every element of E, S, and G. Right, so we work with Clean Edge on some of those indexes that I brought up before. We work with Sustainalytics on some of our broad ESG indexes, right? So Sustainalytics is one of the leaders, right, in ESG, and they've got so much data that they pull together and they look at to determine what's the score of the company, how do they fit in, what are the things that they're doing right, what are the things that they're doing wrong, are they doing things with whale meat, right? There are so many things that I learned when digging into the Sustainalytics data. But there's still only one vendor, right? There's MSCI ESG. There's a whole host of all these other vendors out there that are putting out ESG data that, frankly, some are really interesting too, and they have different opinions and different ways of looking at it. And that's the key and the challenge, right, that we're all faced with. And in Europe, in particular, right, there are a number of ways that that there are governing bodies and guidelines and articles that are put out, and how are you actually classifying your products in the space. Europe's just way ahead of the US in that fashion, but still here in the US, we have over $100 billion in ESG ETFs alone, according to Bloomberg, which Tom might have just said on the last panel, on the last segment. So from Bloomberg. So I really struggle with it. It's hard to give an answer of where my head is at. It's just about what are you trying to get out of when you look at ESG? Are you looking for the E? Are you looking for the S? Are you looking for the G? You're looking for all of them. And if you are, what's the vendor that you actually trust and think is a leader in the space? And that's actually one of the reasons why we work with Sustainalytics, because of their depth, breadth, and knowledge of the space.
Yeah, but don't you agree that if you have 5 vendors, and as the index provider, you need to choose 1 or 2 or 3, and you need to understand how to manage the information that they provide you with, and you are the professional. And if you are the individual investor, you need to understand what is the carbon footprint, what is this protocol about, what is E about, and if they do something about the G, so the governance, if it's correct or not. So if we are actually dealing with this, because we need to face the plenty of information, ESG ratings, ESG data, ESG something, ESG separately, ESG compounded, and ESG methodology, estimations, and prognosis, etc. So individual investors that would like to give a chance to this new way of thinking about the business, yeah, well, I think we are the chosen one to make this decision for them. And there's a huge responsibility, because I need to say that if we talk, generally speaking, about the ESG, I have to admit, everybody has an opinion, and everybody says that, okay, let's put the pressure on this or that side. And what is more, carbon footprint. Let's monitor the carbon footprint, and which scope is the most important. Should we have all the scopes, or the first scope, the production, is the most important? Many questions, very difficult questions. Lack of data provided. I'm talking for the Polish market perspective, and I believe I'm talking about the EMEA region. Yes, because to be open and to frankly speaking, U.S. market is already there. Yeah, developed markets are already there. You have this information. You understand what you have. Plenty of data for the ESG as regards Poland, Czech, Hungary, and all the emerging markets. I would say we are the developed market, but in a way, in some way, we are still catching up as regards the main trends. So. In the respect of EMEA region, we do not have this data yet. And if you say about the billions and trillions of dollars in ESG ETFs, I'm saying that for the moment in Poland, there is no ETFs for the ESG indices. And I think this is the place where something should happen.
And I'll even jump on that too. So if you don't mind, so everything we're seeing from our clients in the U.S. and Europe and abroad, the majority of the inquiries that we're seeing, despite talking globally, so much of it's starting in Europe, right? That's where everything began, right? So we're looking at indexes that we've had around for quite a while, and people are coming to us saying, this strategy is great exactly as is. However, even if there's no change to the methodology, no change to the ultimate basket, we need the methodology to have an ESG overlay. Super interesting story, right? This is something we've been dealing with for the last few years now, last 1 or 2 in particular, very heavily. We're either launching indexes anew, or we're frankly adding a change to a methodology that's been in existence, saying, all right, this index now will have an ESG overlay. This is the way we're going to approach it, right? So we're looking at cloud computing. We're looking at cyber. We're saying, all right, these indexes now have an ESG screen on top of them. And to your point before about the Polish market, you're not as far behind, I'd say, as you think. Right? We just launched the NASDAQ 100 ESG index, late last year. So it's not, middle of last year, and the products tracking launched late last year. So it's not, you're not as far behind, I'd say, in that respect as you might think then. But there's just so much to unpack when it comes to ESG, as you're saying, and I'm saying here that how do you want to go about it? Are we making it? We kind of talk about internally, light green to dark green. How deep in the spectrum do you want to go, and can you go? And still actually have an investable basket? Is there enough data to cover all the things that you want to look at? And those are the tough challenges. And I completely agree with you, Alexandra, that it is on us, but part of the problem too is that if we're trying as the benchmark providers, but if we're trying to create benchmarks that we want people to track, we need to make sure we're getting enough input that there's at least right enough of the world that will say, all right, this makes sense, right? They cover enough of the basics to say we're good with this strategy as it's written. There are enough elements that we're covering and tapping and checking off the box.
Yeah, right. The U.S. market is obviously the most developed market of index funds in the world. What do you think, Ephraim? What is the most interesting product and solution you offer to the investors, and the whole American market is offering investors? Which are the most popular and which are the most exotic products on your market at the moment?
It's a tough question. It's so opinionated, but I've got a few opinions there that I'll offer. So personally, especially with the time that we're in right now, there are a few things that I think of, right, when it comes to inflation, right? Alexander brought up with just so high right now. I tend to think of what's an income solution, right, that can help. And when you're thinking about investing, you have equities, you have fixed income, which is traditional, bonds, treasuries, and so forth. I tend to think of income itself. So not the fixed income from bonds, but I think of income. And we have some really interesting strategies that we offer here at NASDAQ that, and frankly, beyond here in the US that are available. So one in particular, it's called the handle strategy. It seeks, it's called the 7-handle index. So it actually seeks to provide a 7% total return. That's the idea of the handle. Every month it provides, the 1/12 of the 7% as a payout. Sometimes, right, it is some partially from a dividend premium, but some of it is also a return of capital. But the idea is net at the end of the year, you're going to have a 7% return into your income from an income perspective. One of the elements outside of that, and again, we do outside of that handle strategy, just income in general, and options-based solutions, I think are really just at the precipice. There is so much green space there. So the NASDAQ 100 buy right strategy that we have with SIBO and a number of other NASDAQ 100 strategies that we offer, options overlays on top of the NASDAQ 100 just makes so much sense because of the volatility inherent therein and the trading thereabouts. It allows for an increase in premium there as a result of the implied volatility there. So you're getting, if you look at in the US, the Qld Etf is the one that tracks the NASDAQ 100 buy right index. And to be clear, also, this is not giving investing advice, and I'm not pushing products. So this is just kind of giving data points, right? But the Qld Etf, it has around 10 to 11% yield at any given time with what's been going on in the markets. And it's an incredible income stream, and it's been very, very consistent. And that's when I think of what's really interesting that's going on in the US is options overlay solutions. So the Qld Etf has been flying high. It's over $7 billion today. There are other options-based solutions that are really starting to come out in the world and in the US in particular that are really continuing to fly high. There are whole other defined outcome solutions utilizing options, looking at collar strategies, looking at buffer, looking at downside protection, looking at all types of ways that you can package together. So you say exotic, like that options themselves in an ETF wrapper, it removes the risk to the end investor of having to actually buy those derivatives. You're looking to gain those exposures that protect you or leverage you up or down in a way that you're looking to gain that exposure. So that's when I think of super exotic. It's options based. I think of income. I think of handle, again, options overlay. I even go beyond that too. In the US, there's so much thematic solutions that we've come to market with. So even taking a step back, right? We didn't talk about this kicking off the session. I think about how far the index world has come over the last 15 years, right? It really was plain vanilla, right, for a very long time because there was just so much to do there. But then smart beta, right, as Alexandra brought up, started to occur for several years, right? That was a way in index land to create strategies that are rules-based, transparent, that try to get you active type solutions and active beta, essentially, where it gets getting you that alpha in a different capacity. That's why the idea of smart, right, came to me. When they started saying, I remember a lot of people in the space kind of rolling their eyes. And from there, that's kind of continued to go on, and we got to thematic, we got to ESG and thematic. Really been hitting home, and it's going to continue to, right? We kind of see thematic as a way to look at traditional sectors and just blast through them, right? So when you think of technology, there are hundreds of names in technology, but what kind of technology do you want? Do you want cybersecurity? Do you want cloud computing? Do you want AI? Do you want robotics? Do you want electric vehicles, right? So that's where things have been evolving. I see that continuing, frankly, that's really a seismic shift of when people think of sectors, is it traditional sectors or is it thematic sectors? When you think of ESG, is it traditional ESG? Is it thematic ESG? Is it something in between or beyond?
Alexandra, do you see any exotic solutions on the market, on Polish market or any other markets, which we can in the future implement in Poland?
For the moment, Przemek, I would like to concentrate on something that is much, well, I would not answer your question, because at the moment on the Warsaw Stock Exchange, there are the 11 ETFs being listed. So I believe that before we start talking about something exotic, let's concentrate on developing our offer, because it's not like we need to compare ourselves to the NASDAQ, with all the respect from, but we have plenty of countries that can beat us, can beat the number of 11. So at the moment, I believe that the main challenge is to answer the increase in interest rates, for instance, and to make people available not only the curve of the bonds, but for instance the long and short ends of the curve, in order to give the people opportunities to play a little bit with what kind of the bond of what duration they would like to invest in. We would also like to answer the need of the indices for the corporate bonds, but there is a huge problem, or not a problem, a challenge with the liquidity in this area. So that would have the natural implications for the way that this kind of index would be, the replication of the index. But for the moment, I believe, and as I stated before, the index that incorporates some way of ESG, something about the ESG, or the carbon footprint, something that makes us closer to the CTB or PAP, which are the indices being related to the BMR requirements. This is something that might be the most challenging and exotic for the moment. But at this very moment, and in this very moment, let's concentrate on making people understand that passive investment doesn't mean that you are totally passive, and that can give you the basics or make a base for your investment strategy. And after a couple of years, let's talk about something more exotic, like cyber or not cyber technology, because for the moment for instance, we wanted to answer the market request for the index for the gaming, for the gaming sector. Poland is widely known for these gaming opportunities, and we have very interesting offers as regards the companies. But if you gather all the companies for the market as like Poland, not for the market like US, you need to face the problem of the leader in this sector. So you have one or two companies that are very, very big, and the other companies that are very, very small. So this index might be very popular, gives you the opportunity to follow and to monitor the situation in the sector. But the problem is that in order to build up an index and investment strategy on this kind of index, we need to give the second thought for this kind of indices. And that is why we would like to make people understand that it's not that easy to make the new VIG technology, make new retail commerce index, because we need to understand that investing in companies and investing in indices needs to give you the opportunity to have this diversified portfolio. That is why I would also like to, in this very moment, invite institutional investors to talk to us, to consult what we'd like to see. For instance, if the VIG games with equal weights would be interesting for the market. Do you believe that something cross-sectoral will be interesting? It's not that only the administrator decides what is important and what is attractive for the market. I believe that the answer is out there among the individual and institutional investors.
Oh yeah. Now is the question of future of industry, because I can hear that you're saying that the market and the industry is growing bigger and bigger, but I also think that it's getting much more complicated as it used to be. So, Ephraim, what is your take on this one?
So I feel like Alexander and I have hit on some of these, right? I kind of see ESG, right, as something that we're going to continue to grapple with and work through for many years to come, right? So, like I said before, $100 billion in the U.S. in ETFs, that's not a small number, right? But at around $7 trillion is the total U.S. ETF space. You could argue that that's really tiny. That's really a drop in the bucket. Same thing with thematics, right? According to Bloomberg, again, Tom might have just covered this, at around 15% or less of all sector ETFs in the US are allocated really in the thematic lens. So it's around 150 billion or so of a trillion or so that are in sector-based strategy. So again, so much room to grow there. Options-based solutions, I remember doing some research even just a couple of years ago. It was less than $1 billion all in options-based solutions. There are probably at least $20 billion in US ETF options-based ETFs alone today. So there's just so much room to grow in those three buckets that frankly, I'm super excited to see kind of how the next 5 to 10 plus years evolve just in those three alone, but plenty more, of course. I'm excited to see. Alexander?
Well, actually, I have to agree with you. If I repeat these three letters, ESG, it might be boring for everybody, but I think we cannot not run away from this. The easiest example is to make people understand that if we knew the companies that made the effort in limiting the exposure to the energy prices and to traditional energy sources, today maybe they would be happy with their investment. Yes. So to understand that the E letter is very important nowadays, the S letter as respect the global tensions is also very important, and the governance was for quite a long time in the analytics responsible for the biggest gains and the biggest returns from the companies, because if it's governed well, it provides you with a good yield. So ESG is something that I believe is the most important thing nowadays, because we cannot run away from this. I'm speaking from the European perspective. It's not only what we believe in, and if we want to believe that ESG is something tangible, but the number of regulations is actually tremendous. So we need to understand that every index needs to answer the question whether this is connected or not connected with the ESG. And in Poland and in Europe, the administrators of the indices need to inform whether they are compliant or not compliant, and if indices are taking under consideration some ESG factors or not. So I believe that this is a huge challenge. This is a huge challenge, and connected with the regulations. And what I also believe is very important is thematic indices. As Ephraim said, this is very important for index providers and for the funds and institutional investors to concentrate on those sectors that might be interesting and promising for the future of economy. I believe that we are under this kind of industrial revolution again, or cyber revolution. So in this case, concentration on this proper basket of companies might give you the answer where the economy is heading as regards couple of next decades, not only years.
Interesting. We still have some time for the last bonus question, and it goes like this. Many of our viewers are beginners, new to investment world. What advice would you have for them to get off a good start in these uncertain times? Ephraim? I think that we have some technical.
Oops, sorry. Can you hear me now?
Yeah.
Yeah, now we can hear.
Perfect. Okay, there we go. That was bizarre. So sorry about that. So thank you. So that's a very tough Tough and good question. I'd say the most important thing first is to start with investor education and making sure that before you ever look to invest in anything, as I was kind of hitting home on before, it's know and look into what you're trying to do, right? What are you trying to purchase and why? What's your ultimate what's your end objective when you're looking to buy something and put into your portfolio, right? I obviously recommend suggesting financial professional advice, seeking them and so forth. But beyond that, right, are you looking to gain exposure to a new asset class, right? There is, like in crypto, for example, there is so much here in the US that has been occurring and talked about there from conferences and that have just occurred in Florida, specifically on crypto and the ETF exchange in Florida that also occurred. That crypto is a huge topic here. So if that's something you're interested in, I highly recommend just looking into it. Right, education, I would say, is the most important thing before you go to invest, and for yourself in your own education, seeking financial professional advice, and when you are looking to invest, other advice, frankly, it's just, again, digging deep and find out what it is that you're trying to do when you're putting your money to work, right? When you're buying a house, you're trying to put a roof over your head, right? If you go out and buy or look to buy something that you don't know enough about, that's like buying a car without the engine in it, right? You want to make sure you're understanding that you're at least getting all the parts to the car that you're trying to get, right? That when you put the key in the ignition, or you go to put your foot on the brake and push the button to start the car, everything's going to be there, and it's going to get you from A to B, ideally in the way that you're trying to get there.
Right.
I understand that this is my moment now, yes? So adding to what Ephraim said, I really believe that the most important thing, apart from this, what everybody says in every panel, in every discussion, even the private one, evaluate your risk appetite profile. So that's the first thing, and everybody keeps talking about it every time, and every individual might hear that at the beginning of the road. But what I believe is very important is to evaluate and to establish the investment perspective. You need to understand whether you would like to invest and you would like to see your yield and follow your yield for the next decade, or are you thinking about next 20 or 30 years? That would really make a difference when you consult your strategy, or you discuss your strategy with your financial advisor, or you decide by yourself. What is also very important is to understand, and that's also referring to what Ephraim said about the education. We are in a completely different situation that we were in 2021, and especially very different situation that we were in 2020. The cheap money is actually over, although there is a lot of liquidity on the market, but we are in a completely different situation. The global tensions, inflation, and the asset prices, we are in completely different yields area, and I believe that this is something that we need to understand when we evaluate again how do we like to enter the investment strategy. A couple of weeks ago, and no, maybe not weeks, a couple of quarters ago, we saw the yields on the bonds bottoming down, and now we see something completely different. So let's compare what we see on the equity market and on the bond market, and let's evaluate and read a little bit about the general risk on the global markets and in the area where we would like to invest in. Education, knowledge, and investment perspective is something that I believe is the most important thing.
Yeah, true. Unfortunately, the time is up. So Ephraim, Alexandra, thank you so much for being here today with us. For me, it was a pleasure to speak with you and to have an opportunity to pick your brain.
Thank you so much. Thank you, Ephraim. It was great. It was great to meet you.
Thank you both so much.
Thank
it was great. Appreciate it. Thank you so much.
And good luck to everybody.
Thank you, everyone.
Szanowni Państwo, Przemysław Gerszman prowadził panel.
Ladies and gentlemen, Przemysław Gerszman was the host of the panel which has just concluded. We will have a break now until 12:05. And so we'll see you in
Warsaw Passive Investment Conference still live. We've got Matthias as well as Christian with us for the panel. Now it's time for the gentlemen to talk over something very interesting. Namely, we'll consider if ETFs can be a real simple tool to develop your portfolio.
Welcome everybody from our side to this session on ETFs and why ETFs are an important tool for portfolio construction. We are very happy to be invited to this conference as we see especially the Polish market growing in terms of interest regarding passive investment solutions. So for us at BlackRock, we see that this market is one of the leading markets in terms of getting asset growth. Next to me, we have Christian Wievolz from our BlackRock Portfolio Analysis and Solution team, who will join me in the discussion we have prepared for you. My name is Matthias Zeinitzer. I'm in charge of the business development for the Central Eastern European region at BlackRock. Over the last 20 years, approximately, if you look at the landscape in Europe, we saw a huge increase in assets, kind of in money coming into passive investment solutions. And this success story is very interesting for many reasons. So Christian, handing it over to you, what do you think are the main success drivers for this large increase in assets on the passive investment / ETF side?
Thank you, Matthias, and good afternoon from my end as well. Thank you very much for having me today. Great. So I think it's a very important question. I think we're going to go into some of the basics of passive investing to try to answer it. The first one that really comes out there is really this idea of transparency, which I think from a portfolio construction perspective is extremely important. You're looking at portfolios of ETFs that generally have predictable profiles of risk, which make them easier to manage from a risk perspective. That transparency is also very much appreciated by both institutional investors as well as private retail investors. That's, I think, a huge component. The other huge bubble that you see there is this idea of diversification, which, based on one trade, you can get immediate access to either a whole sector, a full region, a set of equities that gives you exposure to a certain factor. It's really a one-off trade with a large amount of diversification. Low cost. I think we were having this conversation 3 or 4 years ago. You could build a multi-asset portfolio with ETFs, index funds at around maybe 30 to 40 basis points. You can now do it, I would say, at around 10 to 15 basis points. So that's 0.1% in total expense ratio, and it's only going to get more and more cost effective. So this is obviously hugely benefiting and investors. And then there's this idea of liquidity, intraday pricing for ETFs, meaning that investors can trade in and out of ETFs for tactical asset allocation throughout the day. I think is a very interesting advantage of ETFs. And then there's these two sources, which I'm sure a lot of you are very familiar with, the two sources of liquidity being both the primary market and the secondary market. The majority of the trading in ETFs happens in the secondary market, but there is that additional source of liquidity, which again allows for better spreads in trading of ETFs. So I would mention those four.
That's great. Just let's stay a little bit to liquidity. Do you see any difference in terms of trading liquidity in Europe than in the US? Is there something you see in terms of the ETF sector that this is different? Or would you also say that obviously liquidity in Europe is as good as we can see it in the US?
I think the US is by far the most advanced region when it comes to ETF adoption, trading of ETFs. I would say for the majority of the vanilla exposures, the spreads on major stock exchanges in the US are probably going to be the tightest. I would say London is not too far behind, but yeah, there is that component of you know, which is one of the big news that I've heard about, you know, ETFs being listed as well in the Warsaw Stock Exchange, adding additional liquidity to local investors, which you've been involved in, Matthias. So
yeah,
I don't know if you
think
want to share any thoughts on that.
That's a good point. So basically, I think also what's aiming is in a certain way that we see large exposures are very liquid on the markets here. I think you probably know that from the Warsaw Stock Exchange for the products here, liquidities even get better and better, but always depending on the underlying. I think on this graph here, we have probably 2 points we did not touch on. So one is access. I think that's a point for later in the conversation because it's a huge topic. Tracking, out of your experience, how important is becoming, let's say, accurate tracking for investors, probably both on the institutional and on the retail side?
When I joined iShares, which was October of 2016, we were still having conversations about certain investors, let's say, having questions around the tracking error of ETFs being too high. I remember some clients not being particularly happy about 90, 80 basis points in tracking error on some emerging market debt product. Tracking error has become so tight over the last years that at least me personally, I've not been involved in these discussions as much. Maybe you have, Matthias, but it seems that the technology behind, you know, the portfolio engineering behind some of these index funds and ETFs has improved so much over the years that the tracking is now extremely good. The question is more around how do I see the tracking in the context of a portfolio. Right, so if you have a multi-asset portfolio and that's tracking a composite benchmark, you really want to understand to what extent that portfolio is deviating in terms of risk sources, in terms of risk profile from that benchmark. Do you have a 1% tracking error, which can be considered very tight, or do you have a 3, 4, 5% tracking error? And this is something we do a lot of work for clients.
I think that's an important point. Definitely, technology helps to reduce these tracking errors on the long run. So now that we talked a little bit of the success and the reasons for that success of passive investing, ETFs, index funds, let's have a look probably on the next question, because if we try to put this in numbers, how large is this ETF market? Is that something, and what does it telling us over the time?
I mean, you can see on this graph, on the x-axis, you've got you know, the time span. Y-axis, you've got trillions in global AUM and in the ETF industry. Sorry, and you can see that it's in 2021 across 10 trillion, which is a huge number. So you know, there's a lot of questions that come out of this. What percentage, what is actually driving it, in which markets? Is it institutional investors? Is it private investors? There's a lot going on here. Matthias, do you want to share some thoughts on what is, how institutions are driving this? And maybe I can add a little bit of
what's
color on the
definitely
retail.
interesting on this global chart is, I think if you look at the time, there has been no single year where you had a fall down of total assets, right? So every year it increased. If you look at 2017, probably in 2018, you see constant. What is interesting, if you look at the pandemic, at this situation where everyone was at home, where we had, let's say, economic problems, not quite being sure how economic models work in the future, you see from 2019 to 2021 a large increase. Right? So this is kind of really remarkable that investors are more and more turning to these solutions, are kind of discovering the solutions, and I think these global figures for the whole ETF industry are really remarkable in that sense. By the way, if you take these 10 trillions, excuse me, this is how much the current market capitalization of the Dow Jones index in the US is, for example, right? So it's kind of a really large number, and you said it already, it's kind of more than tenfold what we can see here. I think the major drivers, and that's probably client segmentation, is that really retail clients started now in the last couple of years to discover that. So mainly driven in the first step by institutional clients, we see now retail clients coming in. This leads me probably to one other question which might be important, because what we often hear with that, and I'm sure you heard that also with your client discussions, is this market overgrown? Are there too many investors in ETFs, right? You sometimes read even that probably index funds, ETFs, so the passive investing might be even the reason for the next market correction. So is that something you can kind of say, yes, might be an issue, or do you? What are your thoughts on that? Yeah, one thing I would add before we get into that question is trying to understand a little bit how the retail, the private investor really plays a role in this trajectory that you're seeing there. I think so. The U.S. and European markets are very different. So in the U.S. You see that private investors generally have a 30–40% allocation to ETFs in their portfolios. In Europe, a typical European private investor will have 10–15%. So the adoption rate has been a lot slower. And I guess there's many reasons for this. One of them is there's a more intermediated market run by advisors in a typical, let's say, European framework. There is still a retrocession model in a lot of countries that is very dominant. There's also cultural reasons. I mean, you know, from an investment perspective, we were talking to a client earlier today, was mentioning how important cash is in the portfolio. This is the case for a lot of private investors as well. And you know, there's also, let's say, operational reasons why, like lack of fractional shares in client portfolios, like being able to really trade the ETF for very small amounts. I think those have all been hurdles in the past, but we're seeing these hurdles become less and less, prohibitive of growth in the ETF industry in Europe. If I may add, I think what's important is especially the cultural approach, because we see that even within Europe. So if you look at portfolio construction of retail investors, you see probably a trend Europe versus US also within Europe. So if you look at the German market, German retail investors and also, let's say, the German adoption of passive investments, this is really high. This is kind of leading in terms of continental Europe. UK put aside, it's probably a little bit different. But that's definitely a large trend we see, which is interesting. And still, this question I raised earlier in terms of, is the market too large? Is it something which kind of could be even a threat for an investor now to enter passive investments? Is something often raised by US names or critics. So what is your opinion, coming back to that, what is your opinion on this one? Yeah, so again, I mean, this is an interesting conversation that's been going on for a while, but if you look at the actual underlying data, you can see that the equity ETF AUM compared to the total equity market is very small. Like you're comparing 7.9 trillion compared to 120 trillion, so it's incomparable, really. It's less than 10%. And on the fixed income side, it is even lower. Like you can see there a similar size in terms of the global fixed income market compared to the global equity market, but a fixed income ETF industry that is still on the rise compared to equity ETFs. So a very small percentage. Yeah. Any thoughts from your end on that? No, I think that makes perfectly sense. And obviously the difference between equity and fixed income, again, is showing you that technology is driving this new way of investing, because for fixed income, it took a little bit longer, the industry, to be developed. I think it's the same, you mentioned it, now on the stock exchange here, there's also a fixed income product listed. So it makes sense to kind of broaden up the offering also in terms of asset classes. I think we're going to look at that later on. One other question, which is probably then attached to this, so if we see that the ETF market is not too large, in a certain way, there's no risk attached to it, what does this figure then really mean for investors in terms of going into such products? I mean, it brings up a very important trend that we're seeing in asset management as a whole, which is this idea of stewardship. So if you are an ETF provider that has 2 trillion, 1 trillion, whatever the AUM is, in shareholder rights, the next question is, to what extent are you actually exercising those shareholder rights? And this lends itself very well to the topic of sustainability, which has been on the rise in Europe for a few years and becoming increasingly important in client portfolios. I would say in terms of,
It really depends also where that equity ETF component is growing. So you see that 7.9 trillion. That's growing with a lot of ETF structures and ETF in certain asset classes that are very dubious in terms of their strategy. So you're seeing a lot of highly leveraged ETFs, a lot of very niche thematic exposures, some actively managed ETFs that can also be one of which hasn't performed very well recently, that gained a lot of fame over the last couple of years. So I think these are risks, systematic risks in the ETF industry that we need to pay attention to and keep in mind. So it's not only about the underlying risk of the asset class, it's also about underlying risk in product development in the market.
Yeah, I think that's a good point to say that obviously with this new way of investing, this new solution, we kind of see different tryouts on different markets, right? So the leverage product being definitely something being in high favor for a certain period. And then if you know how to use it, still has a right to be in the portfolio, but it's not for, let's say, the broad mass in terms of the investor scale. I think what also is interesting is you have to remember on these passive solutions, these, especially on the ETF side, are always as liquid as the underlying markets are, right? So if you take an equity ETF and you are thinking about, okay, is this exposure now liquid for me to trade, even in my small size as a retail investor, you can see that if the underlying market is really that large, and we're talking about, on the equity side, not even 10% or even below 1% or above 1% for fixed income, that there's a lot of liquidity going on. And ETF providers, obviously, around the globe are kind of trying to push to give that liquidity to the client. And I think that's really a great advantage for the end client. I think this was interesting to set a little bit the scene again, to say, okay, where are we coming in terms of the asset growth? What are the main drivers to take index investment, passive investment in your portfolio? I think now we're coming to the core of the question, now that we saw that. Why do we see and are kind of convinced that ETFs are really a very efficient tool for portfolio construction? And here we don't need to distinguish if it's an institutional investor or if it's a retail investor. I think this holds true for every investor. So out of your experience in client discussions, what are, let's say, the main points we can mention here?
I mean, it comes down to one word. I think it's versatility. I think that sums up basically what we're seeing here, which is the ETF industry really have improved to be able to offer investment solutions across asset classes to help build diversified portfolios. Core equities and fixed income, I would say, have played a predominant role over the past, or since inception of rise of ETFs. ESG is a relatively new player, but it's proven to act as a proxy, as a quality proxy in ETFs, especially on the fixed income side. So about 90 to 90, somewhere above 90% of equity ESG ETFs have underperformed their non-ESG counterparts over the last 5 and 10 years. So it is a very interesting proposition that we're seeing there, and a lot of clients have been looking deeper into this, despite the correction that we've seen in the market over the last couple of years and the impact that the energy prices has had on performance of ESG ETFs. But looking further on, there's sectors which have come back in vogue, and especially in the context of net zero transition. So when we're trying to build a portfolio that is better equipped to capitalize on a transition to net zero, it's very important to be very explicit about what sectors you're invested in. Factors have been quite challenged, but we've seen value pick up this year, an enormous amount of flow going to value this year. We've seen quality as well act as a strong ballast in client portfolios. And then commodities has been especially interesting lately in the context of inflation, but even listed alts, right? So one thing we've been doing, and especially in the case of institutional investors who invest a lot in private markets, is really think about how to build a portfolio of ETFs that can mimic or replicate the systematic risk of private market exposures. So be it private equity, private debt, the idea would be to try to understand what is the systematic risk that can be replicated, so not the idiosyncratic risk, but systematic risk that can be replicated from these strategies, and try to mimic that through ETFs. It's something that we call IELTS, but again, a very interesting use case of how, going back to the original point, the original word, versatility. Yeah. I think all of these are supportive to that argument.
And that's what I meant at the beginning, where we had these key features of ETFs. We can also translate it to access, right? Having the possibility to really, even in small investment amounts, being invested in such a different, or such a diversified, that's probably the right word, such a kind of good, well-balanced and mixed portfolio. I think what's also interesting, and probably also a challenge you and your portfolio analysis team is always or often facing, is kind of how can probably especially put ETFs, passive investments, help you towards your risk tolerance? How can that help to express different levels of risk? Is that also something where ETFs is something to supporting that?
Yeah. There's, again, going back to this idea of being able to really build portfolios that have an explicit and a deliberate profile of risk, I think is very important to support. If you're looking on a day-to-day basis, we analyze a lot of portfolios. We see portfolios that are purely built from ETFs that range from a risk of 1% to 2%, which standard deviation of 1 or 2%, all the way up to 20, 25%. So within that range, you can really explore a lot of different investment outcomes. So this is extremely important, because that means that the ETF or passive investments in general can be utilized by both more risk-averse, let's say pension clients, let's say more risk-seeking, let's say asset managers really trying to outperform a certain benchmark. So that's very, very, very important. There's also, in terms of modulating, making sure that you get that precise level of risk. I think certain sectors are definitely important here. Utilities, healthcare have really added a lot of diversification and risk reduction in client portfolios over the last couple of years. On the factor side, that min-vol factor really can play a role. Quality, again, can play a big role. So there's a lot of ways to really combine these asset classes to really build any type of portfolio, again, ranging from an ultra-conservative to an ultra-aggressive portfolio.
Yeah, I think that makes perfectly sense, and we even see that many clients, especially in EMEA now, are asking for different risk profiles built with ETFs. So that's definitely something where we see a lot of interest also from clients to have that. I think what is also interesting here and might be worth to discuss is obviously this purple area where it stands for ESG, kind of sustainability. We know there are different speeds in terms of adopting to this topic, and I think especially we across Europe see that in some markets it's better perceived than in other markets, but I think due to the fact that the regulation is also jumping on that topic, we see a certain train departuring the train station into the direction of getting, you mentioned already, net zero is one point, or even kind of being more aware of sustainability. So from your point of view, what is, let's say, the major challenge or the major question we get in terms of portfolio construction and kind of starting to cover or to cope with this topic of sustainability?
Yeah, I think if we were having this conversation 3 years ago, it would definitely be somewhere, something like, what is the ESG score of my portfolio? That was, let's say, the typical question that we got from clients. We've come a long way since then. I think back then, so we analyzed, let's say in 2019, we analyzed around 400 portfolios, my team. This year, we're going to analyze around 1,200, 1,300 portfolios. And probably around 80% of all those analyses contain something related to sustainability, up from about 20% a couple of years ago. So there's been an enormous amount of rise in interest in this product type. And investors are becoming a lot more explicit, a lot more deliberate about what type of ESG, what is the metric that they're trying to go for. So before, as I said, it used to be around let's say the total ESG quality score, which kind of gives you kind of a high-level ESG metric on the total portfolio, but it's now really shifting into carbon emissions. So how is a portfolio positioned from an implied temperature rise perspective, from a net zero perspective, from a solutions to the climate crisis perspective? And a lot of clients are asking us to optimize. So how do we think about carbon reduction, carbon glide paths? So how do we think about reducing the total carbon emissions of a portfolio over a 1.5-year period down to, let's say, 50 metric tons of CO2 per $1 million of sales as we measure it in the carbon emissions intensity. So yeah, I would summarize it as, you know, clients not kind of having reached a certain milestone of understanding and now really becoming a lot more explicit about what ESG metrics are really going after.
Yeah, and I think to add on that, it's important to mention that obviously if you have these different ways to invest, so one being, let's say, traditional equities, let's take the WIG 20, or let's take, I don't know, the DAX or some US index. If you look then obviously at variations of these exposures in terms of ESG or on the sector side, that having these different flavors of investing does not ultimately mean that it's kind of more illiquid or that you have to bear more costs in terms of going into those products. So I think that's the beauty, and that's why we showed it like we are showing it here on this picture, to say you really have the choice among many different strategies for your portfolio.
I think one important thing that I forgot is this idea of introducing sustainability early on in the asset allocation process, which we did a project called Green Spirit, which some of you may have heard of. It's basically a massive outreach to clients to try to understand trends that we're seeing in the ESG space across various countries in Europe. And one of the main things that we got out of it is that the ESG implementation is always done separately to the asset allocation process. So you will define, let's say, your 60-40 splits, your subcomponents within equity and fixed income, and then at the very end, investors will pick whether to go through a traditional market cap exposure or to go through ESG. And I think this is one thing where we're starting to see some change as well, where we're trying to see more and more investors incorporate carbon emissions and climate-aware assumptions into their economic forecasts. And this is exactly what our BlackRock Investment Institute has done with the implementation of climate-aware capital market assumptions, which are forward-looking risk and return estimates on about 90 to 100 different asset classes to give a sense of to what extent that climate change is really going to impact the return on different asset classes. And that allows for the incorporation of ESG early on in the asset allocation process, as opposed to at the very end or completely separated. So that is a big development that we're seeing in that space.
Definitely something which is, let's say, new for the market to think that way, to kind of incorporate that already at the beginning. I mean, due to the fact that we obviously have this very tricky market situation, I think we should take advantage of having someone from the portfolio construction team in here to probably a little bit discuss what are the trends you saw in passive or index strategies now coming out of this first quarter with obviously more volatility than expected. So which strategies, what was in the, let's say, in favor for clients and what was not in favor in terms of portfolio allocation? If you could share a little bit.
Yeah, it's been a very complicated year so far. I would say general sentiment is still risk off. I think there's been this massive, which is kind of a new investment theme. Well, we've been talking about it since the start of the pandemic, but it's really the idea of what happens when we're almost reaching double-digit inflation numbers in a portfolio context. One thing is actually thinking that it's, or expecting that it's going to come to pass. Another thing is actually seeing it in in CPI numbers across developed markets. And so I think we've been seeing quite a bit of flow into inflation-linked, thinking about using different commodities and different alternatives, alternative funds to act as hedges to inflation, be it infrastructure, be it real estate. I think these have been very important themes over the last few months. I would say the reemergence of value as a trade, I think, has been quite interesting, especially in the context of inflation again. I think that tends to be quite correlated. And then, as I was mentioning before, I would say being very, very explicit and differentiated on your sector allocations, again, not only on the net zero component, which I think hasn't been derailed. I think on a long-term basis, the Russia-Ukraine crisis is actually serving as kind of a carbon tax that will only, over the long term, let's say, speed up the decarbonization process in client portfolios. So I would say that's one thing that hasn't really changed that much. I would say that we get more questions around it, but I think long term, the clients that we engage with are steadfast on reaching that. And using, as I was saying, just using those sector allocations to be very explicit about where to go on energy, express alpha views there.
I think what we should add on to that is obviously that we saw, especially in the trading, on the trading side, on the liquidity side, if you look at these first quarter or the beginning of the year, everything worked as it should work. And I think that's important to re-emphasize at the end that index products, passive products are a product, let's say, for each market phase, right? So either if you're kind of just going into for long-term investment, if you're playing certain views, and that's basically also a lot of that has been now kind of, you told us from your experience for the first quarter, moving, let's say, from something more pro-growth into probably a little bit more risk-averse, switching obviously from equities to fixed income, going, let's say, on the long end of the fixed income market or on the short end. So I think it's important to really emphasize for the portfolio construction, this is an ideal tool to really quickly implement different views, right? Mm-hmm. So anything to add on that? I mean, did we see any really extremely high turnover? As far as I saw, some trends were enforced, but we did not really see chaotic trading, which is very interesting, also on the index side.
I haven't seen massive reallocations, and the reason for this is that the impact on developed markets that the Russia-Ukraine crisis has had has been so far fairly or relatively muted, relatively limited, and I think a lot of investors found themselves on the, let's say, on the fortunate side of not having much exposure to either Ukrainian or Russian assets. And the real idea here, I mean, concepts that, again, as I've mentioned, that have exacerbated over the last couple of months, such as inflation, have already been under discussion for a year and a half or 2 years since the start of the pandemic, really. So it's more of a reinforcement of previous trends than a huge reallocation of asset classes in a portfolio.
Okay, so that's basically the message we wanted to deliver to the audience here of this conference. I think to kind of summarize, it's very important to have a whole portfolio view, to kind of know your estimations for each asset class, and then that's at least what we see in terms of the trend from the investor side across Europe or even globally, to kind of then choose, let's say, the right product to access this asset class. And this is mainly something on the active side we're seeing. Go ahead.
If you had to build a general portfolio for the next 5 years, what would it be? I mean, and if you can look at it from the Polish investors, if it's possible.
Yeah, it's that question would require a bit more understanding on, let's say, the risk profile, on the return estimates.
General.
If we look at a purely unconstrained optimization,
The best.
which is generally what we do for certain types of clients. Family offices tend to be quite unconstrained in terms of what they can invest in. We see allocations to alternatives coming out of our optimizers of up to 40%, which might be surprising to some of you. So, and when I talk, when I mention alternatives, I'm talking private equity, direct lending, infrastructure, you know, which is huge. I mean, it's not a viable allocation to a typical wealth manager. Definitely not a private investor, but that is an important component. The topic of fixed income, you know, we are seeing. I can't give you exact numbers because I mean, again, it will depend on the investor, but we're generally quite bearish on government. We're not too bullish on government bonds in general. We're still quite bearish on linkers. I think high yield in total is coming up quite a bit in our portfolio optimizations. Emerging market local currency is popping up. So a lot of spread risk in that fixed income component. And then on the equity side, I would say we were talking about this earlier this morning, but we're seeing, you know, U.S. You know, the narrative last year was largely investing in European equities from a value trade perspective, but this has shifted into going into the U.S. as a hedge, especially as the dollar has been rising so sharply recently. And also we're quite bullish on Japanese equities, also from a currency perspective. We like the yen. So yeah, it doesn't give you an exact weights, but it does give you a sense of how we're thinking in terms of asset allocation.
I think what we have to address, and that's a very good question, so thank you for that, but what is important in all of the different markets where you are, you have to see if there is, let's say, a meaningful reason to have a local bias. Local bias to, let's say, the local investment industry, meaning, obviously, if you look at the German investor, the retail investor, he has, let's say, probably 15 to 20% in the DAX. Right? It's a large, well-developed market. Does it make sense for, let's say, an investor in a much smaller country where obviously the liquidity of the small country market is not that large? I'm not quite sure. But coming back to the question of the Polish investor having, let's say, a liquid equity market, having a liquid bond market here, obviously having also good solutions in terms of passive investment on these local markets, I think there is definitely a reason also to have a certain amount of the portfolio, and I mean, don't quote me on that, but it's kind of 15, 20%, depending on the risk profile, obviously, to be invested locally. But I think what is something which is probably not good to be too much in that local bias, having 100% just the risk of this specific country. I mean, for the government bond side, it might be easier and even more tempting to have that, but diversification, I think that's the beauty of this passive investment industry is kind of, you can easily diversify your local bias and have a meaningful portfolio and result.
I think that's very important because people forget that I think FX is a risk factor, and that risk factor can act as a diversifier as well. So even if you are invested, if you're purely invested in local government bonds, and from a risk perspective, you really don't want to explore, let's say, China debt or emerging market debt, local currency. One has to look at it from a risk factor perspective to really understand to what extent that new exposure to FX, because the rate exposure and the sovereign spread exposure is going to be limited, but to what extent is that exposure to that local currency in an emerging market country, just to give an example, is really adding risk to the portfolio, if at all. Right, because it could very well be detracting risk if it's diversifying or has negative correlations with other asset classes in a portfolio. It's a very important consideration. I think that's, I mean, maybe that came from a few client discussions that we've had over the past year, but it's, you know, I think it's one of the most important things that we're seeing in Central Europe in the institutional space.
Good point at the end. So thank you very much to the attention for everyone for joining this session. We thank obviously also the organizers of this conference. Looking forward to see the developments of the passive industry here in Poland. And with that, enjoy the rest of the conference and hopefully see and speak to you soon.
Christian, Matthias, thank you so much. Thank you for this presentation and discussion. Okay. Roy Regev from Beta Securities. You have 10 minutes more because you have 10 minutes more.
The what?
10 minutes more for you because we have
10 minutes more. Okay, so we can maybe we can sing or dance together. in this
maybe
10
not.
minutes.
Yeah. Okay.
Yeah.
Roy Regev.
Yeah. First of all, the guys from BlackRock, thank you very much. You're doing a great job, but please leave some money on the table for the other players, hopefully. Is there a place where I can put... Yeah, I'm a little bit excited. It's my first conference after the pandemic, so hopefully everything will go well. What you see here is a picture that I took when I've landed to Warsaw yesterday, and it reminds me two things. First of all, that you have a beautiful country. Usually when I was landing, it was full with clouds. This is the first time that I think I saw the full beauty of the area. And the second thing that it reminds me is it's like a heat map of shares, you know, when you see the stocks with the returns. And I think it should remind us also, especially in those turbulent times when we think that the market will drop by 50, 70, 90%. For the long term, equities generate positive yields. It's happened along the history, and hopefully it will happen also in the next few years. So this is what the pictures remind me. Do I have something to move the presentation? So my name is Roy Regev. I'm the chairman of the supervisory board of Beta ETF. Sometimes I think that my parents gave me a short name because they knew that I will have a long job title. But in addition, I'm also the founder of KSM, which is the largest ETF manager in Israel with more than 12 billion euros of asset under management and 600 products. Israel is well known as a startup nation, but also as the land of milk, honey, and as you will see in a minute, passive investment. Most of the people in Israel would have wanted it to be the land of milk, honey, and football, but we've tried, no success for the last 50 years. Maybe you can borrow us Lewandowski for 3 years. We are promising to bring it back safe and sound after 3 years. But as a good startup nation, we know eventually that we have to concentrate in what we are doing best. And passive investment, as you will see in a minute, is definitely one of the things that in Israel we are doing best. Now, what I'm about to show you in the next 30 minutes is how successful is the ETF market in Israel. But what is more important that I would like you to understand is not just how successful ETFs are, but more how ETF improved dramatically the capital market in Israel and how they can do the same in Poland. And although from the beginning of this conference, we heard a lot of the advantages and the success of ETFs around the world and foreign ETFs, we have to remember that our major target is first and foremost to make Warsaw Stock Exchange one of the most successful ETF platforms in the region, and we can do it. So without further ado, let's start to speak about the Israeli market. In the last 20 years, the Israeli market has grown from 0 to 50 billion euros of asset under management. Two things worth mentioning. The first one is that 20 years ago when we just started, there was an absence of knowledge of what are ETFs. So, for example, when we wanted to issue the first ETF on the Tel Aviv 25 index, the Israeli Security Authority asked us, and listen carefully, they asked us to issue 25 different prospectus, one for each of the different companies, and not just that, they asked us to get the approval of each of those companies. The next thing I was thinking is, okay, I will deal with the TA25, but what will happen with MSCI World? I can travel all around the world, but it will take some time. So happily, ISA understood the potential of the market, and eventually they've built a legislation that was suitable for the emergence of the market. And one of the important factors in the Israeli market is that ISA went hand in hand with us, built a legislation dedicated for the growth of ETFs and brought the market to the place where it is right now. Second thing worth mentioning, it's the emergence of the products. As you can see, the first year, the first product to be issued in the Israeli market were ETFs. Only 10 years afterwards, index funds were introduced. And why it is important? It is important because although index fund and ETFs provide the same tracking on indices, ETFs are more holistic products. They target not just the investor, but they target also brokerage houses and, of course, the Tel Aviv Stock Exchange platforms. And because they are targeting also other market participants, we had more power to grow this market in Israel. And just to show you how successful is the market in Israel, you can look at this slide. Usually, when you would like to check the success of an ETF market, you check the passive compared to the active funds. And in Israel, the proportion is 56 to 44, even better than the US, which is one of the, actually the best passive investment market in the world. And I hope and wish, and I think we can do it, that in Poland, which today we are talking about 95 to 5, in Poland we can reach the same success as we reach in the Israeli market. As of 21, the number of products that are listed in Israel are 1,122 products. And as we're speaking right now, it's almost 1,200. Just to give you a sense, I think that in the whole US market, the largest market in the world, I think there are 3,000 or 4,000. So 1/4 out of it is in this small market of Israel. Most of the money is concentrated on 3 segments: foreign equity, local equity, and corporate bond. And the main reason for that is that usually institutional investors, when they are looking to invest in ETF, what they are looking for is places when they don't have any relative advantage. Niche market, like investing in Japan from Israel, or investing in India, or even in the US. So this is one reason why we see a lot of the money put into foreign investment. The other one is hard times to trade specific segments. For example, corporate bonds or mid-cap or small-cap. And for example, I can give you in Israel, the mid-cap index has much more asset than the large cap in Israel because of that reason. If you were thinking by what I've already shown you that, wow, it's a great market, maybe I'll take my package and immigrate to Israel and build my own ETF company within this market. So I suggest you hold your horses or maybe hold your zlotys. It's a highly competitive market. ETFs, unlike active funds, are generic, which means that when one company is issuing a VIG20 index and the other company is issuing a VIG20 index, it's the same index. And the differentiation is within the service. What is the management fees? How is my trading and the spread? How accurate I'm tracking the index? And in that matter, I can tell you that in some situation, we are losing trades in Israel for only 1 basis point. So you have to be highly professional. So professional that even BlackRock, and excuse me guys again, they are a great participant within the local market, but when they try to list their own products within the market, they found it very difficult. I think this is something which is very important to the local market. I think it's better and great to build local knowledge that eventually Beta ETF will compete with PKO and with INPZU, beside, of course, competing with the large companies that will anyhow be there. The additional issues that I can refer in order to the high competition is the advantage for the investor. You have to understand that investors are eventually enjoying a highly competitive market with narrow spread, with low management fees. I wish that every market in the world was highly competitive as ETF. It could be banks, it could be cell companies, whatever. I think this is one of the most competitive markets, and it's for the benefit of all investors, including private. The market is heaven. I mean, the Israeli market is heaven for asset manager and investors. And the reason I'm saying that is that in the Israeli market, you can find almost every solution you can look for in the ETF industry, either if it's a benchmark, if it's sectors, if it's a thematic, if it's foreign indices. In some of the indices, we were even the first in the world because we had the ability, we had the innovation. We've issued the first, I think, ETF on oil. We've issued the first ETF on India. And think about this private investor or institutional investor that can, from his local bank, in local currency, in local trading hours, can enter into the same platform that he used to buy shares and get an access all over the world. This is one of the major advantages that I think can be provided also to Warsaw Stock Exchange, and it's happily happened in Tel Aviv. Very, very short, the most popular index in Israel is the S&P. We are a great fan of US, and for cause, and I think in the last 5 years, S&P rose by maybe 20% annually. But this is the list of all the popular products in Israel. When you're looking about client segmentation on TASE, you see that, like all around the world, the large portions are within private investors. But don't let this chart mislead you. Institutional are one of the most important players within the ETF market. Without them, actually, I don't think that we had this kind of a successful market in Israel. And why is that? In order to issue new products, we have to get soft commitment, a substantial amount of soft commitment. It could be millions to tens of millions. And the only one who can help us in doing so are institutional. Of course, private are very important. And when they are coming, they are bringing more assets. But in order for us to issue a very low commission S&P or cyber or electric vehicle, we need someone to come with few millions in advance. And that was one of the major roles, and still is, the major role of institutional within the Israeli market. The second important role is that usually institutional are thinking for longer term, which means that they are more sitting down on the asset, making the ETF more stabilized. And not just that, in a fast market or in a turbulence market like we are suffering from in recent days, in some of the cases, institutional are acting against the private investor because of their long-term vision, making, of course, the liquidity and the spread in the ETFs much more lower for the benefits of everyone, and of course, lowering the volatility of the market. Nevertheless, private investors are highly important. I'm glad for them that eventually Mrs. Kowalski, I think it's one of the most common names in Poland, maybe, Mrs. Kowalski gets the same terms as the largest pension funds. And I see it's a great advantage. You don't see it in many other places. Try to get the same terms at your bank accounts like a big energy company. You can't. In ETF, you can, and this is, again, a great advantage. At the base of every successful index market, there has to be an index vendor. And when we started 20 years ago, there were less than 5, maybe 10 tradable indices on TASE. Most of the indices were statistical indices that you looked about a comparison of the energy stocks, but you couldn't trade them because of many things. TASE also understood the potential, and together with us, built numerous number of tradable indices, and the result you can see here, They are controlling the market with more than 600 products linked to Thematic Indices, more than almost 25 billion euros in assets. And of course, afterwards, additional index vendors enter into the market and make it more vivid and with more possibilities. But Thematic did a tremendous job here in order to make this market success. Last, in terms of the description of the market, is the trading volume. Try to think of one segment that you believe can provide additional 30% in trading volumes to Warsaw Stock Exchange. ETFs can do so. What you see here are the figures of the Israeli market and the US market. On average, the daily volumes in ETFs in Israel and the US generate almost 30%. Now, it's a lot, and it's one of the great benefits. You remember the first slide that I start about the benefits for Thematic and for the brokers? It's a great benefit for the brokers because it generates an enormous amount of money. It brings more investors who would like to invest in ETF, and it exploits these magnificent platforms with these big buildings in the best way. Because this is the purpose of Warsaw Stock Exchange, and this is the purpose of Tel Aviv Stock Exchange, to provide more liquidity, to create more trading, and ETFs are the ones. And as I said at the beginning, what is more important is not how successful is the ETF market in Israel, is what success it brings in general to the capital market. And I will go through very fast some of the major advantages. First one is liquidity or in-depth. 20 years ago, there were 400 companies listed on Tel Aviv Stock Exchange, but only 25 were traded. So it was like a big mall with a lot of shops, but most of them were closed, in the dark. Only one supermarket was open when the investor entered into this supermarket and traded those 25 different shares. I think, as I looked at the data, it's the same in the Warsaw Stock Exchange right now. You have 800 companies, but most of the trading is conducted within 20 shares only. And that's a problem. And when ETF entered, and when they've issued the mid-cap ETF and the small-cap ETF, they actually brought up the light in those shops. They provide liquidity, they provide transparency, they provide ability not just to trade the ETF, but to trade the shares themselves. I can tell you that before the ETF came, most of the illegal issues that happen in the Israeli capital market happened in those dark places because no one treated them, no one take care about them. When ETF entered, I remember getting calls from a nervous institutional who were telling me, "What are you doing? Why are you moving the market so fast? It was very quiet there, no one paid attention." That is exactly what we need to do. We need to pay attention to those places. We need to exploit best this platform. And this is one of the major important. You can see in terms of the figure from 12% only on trading volume in the backbone of the mid-cap to 30%, and it's growing. And in addition to that, I think we need to put her at a table. It will be much more comfortable. Sorry. In addition to that, Thematic started using the success of ETFs to attract new companies. And why it can attract new companies? Because suddenly there is a market of 20 billion. And if you are coming to Thematic and you are 1% of the Tel Aviv 125, immediately you are getting almost 3 million euros at the first day. Now talking about liquidity. So being part of an index became a prestige. And again, 20 years ago, who could care less? Well, what do I care? I mean, I'm talking about the companies. What do I care if I'm at SVIG 40? What it brings me? It brings you a lot. It brings you awareness. It brings you liquidity. It brings you value of money that we are, as the ETF issuer, we are working very hard for it, and you are enjoying it. And today, companies are eager to be part of indices in the Tel Aviv Stock Exchange, not just the blue chip, but also the small cap, also the sectors, you name it. And when TASE is using this data in its favor, it brought, for example, to TASE 52 dual-listed companies. And I'm not talking dual-listed that are coming from very small exchanges. I'm talking about dual-listed companies that are coming from the US, from the NASDAQ, from New York Stock Exchange, from European exchanges. 50 companies, 10% of them. And beside that, TASE last year was, I think, in the highest rank in the issuance of new companies, more than 100, almost 100 companies, but more than 170 in the last 5 years. Majority of the reason for these things to happen are ETFs. So you have to understand, investors, brokers, it's not just, when you're investing in ETF, it's not just promoting our segments. It's promoting your market. It's promoting your financial supermarket. It's for your benefit. And of course, with the eager to be part of the indexes, the corporate governance is being improved because companies cannot do whatever they want. You want to be part of the index? Okay, raise up your public holdings. Make your business more focused if you would like to be in an ESG or in other sectors. So in general, ETFs made the market with more quality companies without having to have a very tough legislation. We talked about the importance of the private investors. One important thing to say, you see the growth of the private investors account in Israel. I think it's almost similar as in Warsaw. I think that a stock exchange without ETFs is like a cellular phone without iPhone. Private investors are eager and are looking for ETFs. And if they will not find it here, they will look elsewhere. And that's gladly for TASE. It's enjoy its growing customer base of private investors. In terms of TASE, and this is, I think, one of the most interesting things that happened to it, it became a global platform. Because if all those ETFs are traded within this electronic application, why should I, as an investor, open an account at the IB broker or whatever? I have everything here in the local currency, in the local time hours. And today in Israel, there are almost 600 different foreign ETFs. They are responsible for 40 million euros of trading every day, 80 billion euros of asset under management. I think it's a wishful thinking to every exchange all around the world, and especially here in Warsaw. ETFs brings efficiency to the market, not just in the decreasing of the management fees as we saw before, and you can see here in Israel, but even in something which is much more interesting to investors and to institutional investors. ETFs decreased the spread. And now you have to understand, spreads are like a silent killer because you don't see this commission when you are trading the stocks. But eventually, when you see the returns, and if the bid and ask spread is more than 1%, eventually you are paying for that in your returns. And when ETF came, they've broadened the liquidity, they lowered the spread, and eventually they made returns of any asset manager, private investors, or even the largest pension funds, much better. When we've entered with our first small cap ETF, the spread on the small cap in Israel were 2 to 3%. If you want to create a deal of few millions, it was even 5%. Today, we can generate on the small cap index in Israel trades of 10, even 15 million with the spread which is less than 80 basis points. It's an enormous advantage. two last things in terms of the advantage before I'm entering into the last section of speaking about what is really interesting, the Warsaw Stock Exchange. ETFs provides more revenue. Okay, we are here eventually not just to speak about ETF and to meet wonderful people. We're here to make business. And those 140 million average daily volumes that are generated through ETFs in Israel generate money. They generate money for the exchange. They generate money for the brokers. And when I was summing up the revenue that brokers are generating just from direct trading on ETFs in Israel, it's more than 150 million euros a year. It's a lot of money. It's a lot of money. And also the Israeli Security Authority and the exchange are generating an interesting amount of money. You can see it beneath. So it's a win-win-win situation. Win for the private investors, win for the platforms and the brokers, and also win for us as an issue. It's the best industry that I can think of, and I'm glad that I'm actually part of it. Yeah. And now, they're supposed to be here now, a film of, you remember Jerry Maguire when Show Me the Money? Kobe, I wanted to put this film, but because of royalties, I couldn't. So I will show you the money. The main question here is, okay, I've showed you how successful is the Israeli ETF market, what benefit it can provide to the, also to the Tel Aviv Stock Exchange, to Warsaw Stock Exchange. But the main question is how you can do it. And I can sum it up into three major factors: infrastructure, distributors, and issuer. This is specifically for the Israeli market. When building any new industry, any new city, you have to have infrastructure. Without the antennas, we couldn't have a cellular market. Without the charging for the electric vehicle, we couldn't have electric vehicle. So without the right legislation, we can't have a successful ETF market. And in that matter, the Israeli Security Authority did a tremendous job working with us in building this industry. It understood the potential, and it made an ad hoc legislation just helping us issue products very fast. And they are the most important part in this evolve of our market. The second one are the distributors. Now in Israel, there was something very unique that happened. I think it's the only place in the world. I will tell you what happened, and then I will tell you why I don't think it's too relevant for the success of the other market. The regulator in Israel decided to separate the banks from the product. It told the banks 15 years ago, look, you can't be in both sides, because in that way you will be biased to your product, like happened naturally in all of the market. So he told the bank, look, you have to sell your product, and then you have to give only services as asset management. And in one day, financial advisor become totally objective. And of course, that make the market blast when it started. But distribution channel understood, even beside what's happening in Israel, that ETFs are great for them. Although brokers, houses, and asset managers are within the same banks or the same investment house, there are different entities. And brokers understood that promoting ETFs promote their business. They can generate more money, they can bring more customers, and eventually, this is what I am as the manager of the brokerage house. This is my target. This is what I was assigned to do as a CEO of this brokerage house, to bring more money to my system. And I don't need to care about not moving the cheese to the other part. Eventually, it was for the benefit of everyone, but this is, again, something which was very important in Israel. Distribution channels start opening themselves, educating the market, letting us speaking with the customers in order to educate the market. And the last word, the issuer. Because the ETF market in Israel started back in 2000, the knowledge was very little about the market. And because the ISA gave us a lot of responsibility, because they need to make a specific legislation just for us, we had to be highly responsible. And gladly I can say we were. And besides giving this responsibility, we invested initially a lot of money, a lot of effort, brought a lot of innovation and a lot of our skill. And together with the Tel Aviv Stock Exchange and the Israeli Security Authority, we succeeded in building a great market. And after this long lecture, I'm entering into the final phase, and I think the most important, and this is the reason that I flew all the way from Israel, a very long 3.5 hours. I'm very happy to be here. And my main purpose is to see how we can bring the same success to the Warsaw Stock Exchange. Initially, when we thought about entering into a new market, we saw those figures on the Warsaw Stock Exchange. And Israel and Poland are they're not so similar, but in some matters they are. In one matter, definitely, I can tell you that half of the Israeli population are originally from Poland. I'm married to one, happily. So in that matter, we are definitely the same. But Poland is 4 times bigger than us in terms of population. But our life expectancy is a little bit higher than you guys. I can tell you that the problem is not the women, it's the guys. I don't know what's eating you, but you need to check it. But in terms of the economic point of view, we are both growing in much higher phase than developed markets. You are even more than us. Before the pandemic, on average, we grew by 3.3, you by 4.5. GDP per capita, almost the same, and we are both an investment-grade companies. And an additional slide is when we are talking about specifically on the capital market, you can see here two factors. The first one is the household holdings, and the second is the exchange platforms. In terms of the household holdings, in some parameters we are the same, like the deposit. Israeli, like Poland, are very defensive. We have a lot of money in the banks that actually is losing money because it's not generating money, it's just waiting there. And I think this is something that it's a target all around the world. We are also quite similar in mutual funds, but in pension funds there is a big difference due to the ZUS regulations that actually took a lot of money out of the institutional. But still, in Poland you have 600 billion euros in household holdings, and in Israel it's 1.4. When you're looking at the exchange, and this is something that I think shows the potential, I think the Warsaw Stock Exchange has a much greater potential than Tel Aviv, because we are eventually a small island. We can't do more than what we can do in Israel. Poland can become a regional leader. You have the ability to put your hands on other countries which are smaller than you, like Hungary, Romania, Czechoslovakia, or whatever, and to become a regional platform, sorry, yes. So the potential is there, and not just it's there to exploit. And here are some more figures to let you understand why we just need to take our hand and pick this potential up. You have everything. Based on the calculation that we've made, there were 500,000 active accounts on the Warsaw Stock Exchange last year. It's a lot. It's a lot. If it was 50, I would say, look, it's not our job. First of all, let's make the market to be more vivid. But it is. And those 500 customers that are entering into your financial supermarket, eventually They are finishing by buying milk and bread, but they can buy much more. They want to buy much more. And this is one great potential. An additional is, of course, the number of companies. Most of the companies that are being listed at the exchange are actually abusing the resources of the exchange. They are listing themselves, taking some money, and then stay in the dark. You know, their shop are closed. I don't have any trading. Most of the holding is with the shareholders, not with the investors, and I couldn't care less. And in total, those 800 companies, including the New Connect, it's a great potential. We can build great indices here. We can build sector indices. We can build thematic indices. You name it. 12 billion, approximately, is already invested in ETFs by local investor here. But sadly, it's invested outside because your investors here in Poland don't have any alternatives. And when they don't have any alternatives, they go to foreign market and buy it there. Today, among the, out of these 12 billion, less than 200 is invested through Warsaw Stock Exchange. We can do much better if we will provide them with the products. I'm repeating it again and again because this is the most important thing. Let us issue as much as product as possible. Bring BlackRock here, so maybe it will list its own products within this platform, instead of losing money outside. You have a very successful PPK market, the pension market, and why we should let those institutional investors look for their alternative abroad. Let them look for the alternative in Warsaw Stock Exchange on the platform. And two last things for the potential. We talked about the sectors. You have also great indices. I can tell you when we are checking the performance of some of the indices, the VIG 40, the VIG 80, the TBSP, you know, the government bond, they are performing great compared with the active management. And people just need to be aware that they exist. So what we need to do in order to achieve those great advantages? In short, okay, I've jumped, so I'll just, okay, I'll go back forward. In short, two things. Just like happened in the Israeli market, in Poland, we need the help of two factors, two vectors, two entities. The first one is the KNF. The reason I'm standing here is because of the KNF. The KNF did a tremendous job helping the ETF market to evolve. They've built us the small bridges, the small roads, but now we need the KNF, and I don't know if someone from the KNF is hearing that right now. We need you to buy us highways. I would like to be able to issue 20 products every year, 40 products every year. I can do it. But in order to do so, I need the right legislations. Today, in order to issue new products, I need to pay a lot of money and to wait 6 months, a year in order to do so. And in some of the products which are very unique, it could take even more. Help us help the market. We can do it together. We know how to do it. We did it. So this is the first thing. And the second thing are the distribution channels. Hopefully, you saw what I've presented in my presentation. It's not just supporting a new market. It's not just supporting Roy Regev so he could come to Poland every week and not every 2 months. It's not that. It's supporting yourself. Supporting ETF, it's making the Warsaw Stock Exchange a much better exchange with high-quality companies, with more liquidity, with more investors, you name it. You have the potential. The only thing that you need to do is to understand that by addressing your customers to this segment, and specifically, I say, within the local market, it's all right that they will buy in foreign markets. They will do anyhow. Even in Israel, a lot of the money is invested abroad. But bringing, first of all, to the local market, it will be for the benefit for everyone. And going back to 2 slides that I've just passed very fast, as of today, I don't know how many of you understand that. As of today, there are already 41 passive products within the market, only 11 ETF, which I think it's more important, but 41 different products. The market is growing. Although the mutual fund industry is decreasing, the passive investment market along the current quarters, even in these turbulence days, is growing, and it's currently 5 billion zloty, still very low to the potential. It's only 2.5–3% from the active, from the total mutual fund industry. And to my belief, if we can work together in 5 years from now, and this is not something that I'm just writing, it's from my own experience, in 5 years from now, we can make a market of 50 billion zloty, at least 200 products listed on the Warsaw Stock Exchange. Thank you.
Roy Regev, thank you so much for this presentation. It was fantastic. Of course, Czechoslovakia, it's 2 countries now, Czechia and Slovakia. You said 1, but I think it was short. Thank you. I'm not from the region. Szanowni Państwo, dziękuję pięknie.
Ladies and gentlemen, I said many things indeed for today. But that's not it. Tomorrow's going to be the second day of our conference, so we'll reconvene at 10 a.m. tomorrow.